All right, guys, so welcome to class 6 of the day trade course. This is a three-part class. We've got part 1, which is the gap and go, part 2, which is momentum trading strategies, and then part 3, which is our FAQ session. So um, I will forewarn you that this is probably the longest chapter of the entire course because the momentum trading strategy um, is how I make a living trading. So I need to show you all of the details of that strategy, and you will probably have to watch this class more than once, and you may need to break it up into even smaller segments if it's too much content to digest at once. And that's fine. The last 5 classes have really been building your foundation for this class today. You know, class 1 on risk management, class 2 on stock selection, class 3 on daily patterns, or topic 3 on daily patterns, and then topic 4 on intraday chart patterns. And now here we are, topic 5, class 6, because of the intro class, on the momentum trading strategies. Okay, so today's a day where I finished with my own trading up about $1,200. It was not a bad day at all. It was, you know, maybe a little bit slower compared to 6,400 yesterday, but something that I'm really mindful of is the fact that I often have big red days and big green days back to back on both sides. So I'll have a losing day and then I get aggressive to try to make back that loss and a big green day. And then I get a little complacent, and after a big green day, I can have a big red day. So I want to try to avoid some of that up and down whipping around and get more into just kind of steady $1,000 a day gains. I mean, $1,000 a day is $5,000 a week. You know, that's well over $250,000 a year if I can be consistent. Last week I made 5,000 at the end of the week, but I made 10,000 and then gave back 5,000. So, you know, that's kind of where it's like becomes a little more stressful. It's not as enjoyable to end the day on a big loss. And so my goal this week is to, you know, try to bring it back a little bit, rein it in. But of course, you know, using that same kind of approach that we've been talking about, you know, the spearfishing approach, waiting for the perfect setup, calm, cool, collected, and then strike. And that's what I did today. I just saw it and I jumped in. 3 trades, 3 winners, and that's 1,200 bucks. I just scaled down share size because I wasn't totally confident on some of the setups because I'd seen some choppiness in the overall market. Okay, so that's for a little bit of an intro on, you know, or a recap of my trades today before we jump in. So, as I said, the momentum trading strategy, this is what I spent 2 years developing. 2 years of strategy development to get to the point where this was a rough strategy. It's taken me several more years to refine it to the point where it's at for today for my own trading, and of course, several years to refine the classes to the point where I can teach you this strategy. A lot of traders who are really, really good, just naturally good, they can't articulate what they're doing that works because you know they don't maybe know exactly what it is. It just is a natural skill. They're just naturally really good at trading. And you know the issue there is that people that are naturally really good at things are not always the best instructors because they didn't have to go through the process of struggling before they found success. Okay, so the momentum trading strategy is simply a strategy for capitalizing on a stock experiencing strong trend. So a stock moving up strongly that's already moving up strongly on its own, I want to find a way to capitalize on that opportunity. A stock that's going up 10%, is there a way I can capture part of that move? You know, 5%, 4%, whatever. So when we're looking for momentum, we're looking for a stock that's moving up quickly. Momentum typically ends when the stock reverses and changes directions, which means it's breaking down and crossing below what moving average? What moving average would the stock have to cross below in order for us to say it doesn't look like it's really in play? Any idea? The 9 exponential moving average. Right, you guys are on it, okay, for those of you in the live class. So a stock is out of play typically when it breaks below the 9, although sometimes it will break below the 9 and then catch support at the 20, which is okay. It's not ideal, but generally speaking, the strong momentum ends when we break below the 9 moving average. Now, what you're going to learn today are my favorite day trading strategies, the strategies that I use to take $583 and turn it into over $100,000 in 44 days. These are momentum trading strategies. So these are my set of rules for capitalizing on stocks that are experiencing trend. So remember when I talked about the fact that there are 2 phases of trading. Phase number 1 is strategy development. It took me 2 years. Phase number 2 is trading that strategy. Phase 2 is easy. My job right now is super easy. I just come in, I look for the stocks gapping up, I follow my rules, and I book my profit. I mean, this is the easiest job in the world. I could do it in my pajamas. I mean, I could do it from a beach. I mean, it really is super easy once you have the strategy, once you have that set of rules, that framework for how you're going to trade the market. And then at that point, the biggest challenge is following the rules, right? Not deviating from the strategy, because when you do that, you'll experience losses. And of course, having the patience to wait for A-quality setups to weather through some of the slow periods and that type of thing. Those are maybe the challenges. But for me, trading and being profitable is easy. It's just a matter of following the rules. So today we are we're doing that strategy development. I am showing you the template that I use for trading the markets. So we're combining everything that you've learned so far in the intro class, and then the first 5 classes. Those are your 5 pillars that we're going to build this strategy on top of. We're going to apply everything we talk about today to stocks where you can manage risk, to stocks that meet our 6 criteria for having home run potential, for stocks that have good daily charts, and for stocks that have intraday patterns. So a lot of the strategies that we talk about today will utilize intraday patterns as entry points or as exit points. So this is absolutely building on what you've already learned. Okay, why is this important? And I have this slide, just because I want to make sure you understand when we're starting a class what you're going to learn and why this is an important thing for you to understand. It's important because these are the strategies that I use to make a living as a trader. These are the strategies that's allowed me to live in Vermont, in a place where there aren't a lot of high-income jobs. It's allowed me to live in a rural area, in an old farmhouse. This is the strategy that's given me complete financial freedom. It's allowed me to pay off all my bills, to own everything that I own outright, to not have debt, and to have the peace of mind that I now have a skill that can carry me through potentially and hopefully the rest of my life, unless something crazy happens with the market and we go into apocalyptic times. But pending that, this strategy will hopefully carry me through at least the next 15, 20 years, until I may decide to retire, at the age of 45 or 50, which would be completely realistic given the amount of money I'm making each year trading right now. At the same time, we have students in our classes, even right now, and you guys can shout out if you're in this group, who are in their 60s, 70s, and 80s. Some of you have been doing this for a while. Others are looking for just a stimulating hobby that's enjoyable, that gives you a reason to get up every morning at 8:30 and is exciting and fun. And it absolutely is. We've had a trader in this class who was in his 80s, literally. And fortunately, he was good with computers because he was doing, early computer work in the 70s and the 80s. So computers and technology was not an issue for him. And he jumped in and he was trading side by side with us. I have to check in and see where he's at now. But it goes to show that, sure, you could retire, but because you've made enough money. But at the same time, it's such an easy job. It's mentally stimulating. Why would you want to retire? It's not like working a 9 to 5 at a factory where you're like, I can't wait for retirement. This is a job you can do, well into your golden years. Okay, so the first momentum strategy that we're going to talk about is the gap and go strategy. The gap and go strategy is a technique for capitalizing on the volatility that stocks gapping up often show. So we know for a fact that almost every single day there are 10, 15, 20 stocks gapping up more than 10%, meaning they're going to open 10% higher than they closed yesterday. And what is a good reason why a stock would gap up 10% overnight? Who has an idea? It's news. It's a headline. It could be earnings. It could be that that company has just signed a big contract. There's a reason why this morning there are more buyers than sellers. The imbalance between buyers and sellers has created the gap. So whether it's patent news, a government contract, FDA announcements, clinical trials, there is most likely some type of underlying fundamental headline that's driving the stock higher. Sometimes it can be something as simple as this is a very strong sector and there was news in another stock in a similar sector and you have sympathy as the whole sector seems to rise up. But generally speaking, the stocks that are going to open higher because they have a catalyst, they have a reason. The gap and go strategy is a unique strategy that falls under momentum trading because we are trading momentum, but it is designed to be traded from 9:30 until 9:45. It's a 15-minute long strategy. That's a very small window of the day. I've really narrowed down my peak performance all the way to a 15-minute window of the day. That's when we trade this strategy. From 9:45 until noontime, we'll be trading different momentum strategies. But even from 9:30 until noontime, we might trade momentum on stocks that were not gappers. But for stocks that were gapping up, the gap and go strategy is traded from 9:30 to 9:45. Now remember when we talked about a pattern being simply a pattern, not a strategy is when you put together all of these details. So the time frame for a gap and go strategy, time frame 9:30 to 9:45, sometimes allowing for pre-market trading. Although I generally don't, you can sometimes. The stock type, low float under 50 million, less than 10 million is certainly preferred. Requirements, the stock should have a catalyst or be a former runner. It should meet our 6 criteria for being a stock in play. Low float with a catalyst, strong daily chart, et cetera, et cetera. The price range between $1.50 and $10 is best for account building, but all prices work. And that's true. You could trade gap and goes on $30 or $40 stocks, but think about what the collective group of traders are going to be trading. They're going to be looking usually at the 1 or 2 gappers that are at the top of the list, that are gapping up the most. Those are the obvious setups. Of all of the sparkly stocks, those are the sparkliest. Those are the ones that most traders are going to go for. So you have to think about what the group is going to be looking at in terms of collective trading mentality. Accuracy for my trades at this time, and this was when I first wrote this, was 78% on the gap and go strategy. So accuracy for me was really high. My profit loss ratio was 1.5 to 1, which is less than the 2 to 1 target that we aim for. So that meant I made $150 average on my winners and I lost 100 on my losers. So not quite 2 to 1, but that high level of accuracy made up for it. How do you find these stocks? You find them on the Trade Ideas Gap Scanner, which we stream in the chat room every single day for you guys, and which we also have embedded on the day trade watch list every day. How do you find exact entries and exit indicators? I will show you today. All right, so this is the gap and go strategy, and this is certainly a slide that you'll be able to print out from the PDF if you want, or simply write down these notes. This right here is a great example of a gap and go stock. This stock was gapping up, CDTI, it was gapping up to about 251 pre-market. We had the first pullback pre-market, and we moved up, the second pullback, and remember, I'm willing to buy the first or the second pullback. I really don't ever trade pre-market, so if we have the first pullback pre-market, I'll just let it do its thing. The second one, let it do its thing. By the time we're on a third or fourth pullback pre-market, I'll be that much more cautious about trading when the bell rings because I'll feel like I'm not the first one to see this stock. I'm not the first one to the party. A lot of people have already seen it before me, and I might just be late to the party, and then just be best off waiting for maybe a 5-minute setup or just completely sitting it out. But in this case, we have the first pullback and the second, and so my entry would have been right here at 251 because this is the pre-market high. Now the pre-market high in this case is also a half dollar, 250. So I could get in at 249 or 250 for two setups. Number one, the half dollar break, and number two, the break of pre-market highs. Now I'll go over, in more detail the entries that I take, but just so you see, this is a setup entry at 251, and there's a move from 250 up to 3, pull back at the whole dollar, and then break through 3 and all the way up to 340. So, that right there is like a 30-40% move on a gap and go setup. This would be an easy opportunity to make $4 or $5, maybe $10,000, depending on your position size. So the gap and go checklist. When we're scanning for the gappers, we're scanning for gappers of more than 4%, number one. Number two, we prioritize the low float stocks higher on the list. But generally speaking, and I'll just grab my gap scanner just to show you here. This was the, oops, where'd it go? This is the gap scanner for today. I'm going to go to time frame and historical data. We'll scan for 9 a.m. So this is how the scanner would have looked this morning at 9 a.m. So at 9 a.m. you can see, okay, these are all the stocks gapping up more than 4%. And there's a good number of them, 20, 30, whatever. So of all of these, do you think traders are going to be looking at, these ones down here or the ones at the top of the scan? Because these scanners are readily available. Traders all around the world use gap scanners, and they look at the stocks gapping up the most. Now this stock was a buyout. It was bought out by another company, so we knew this was just going to trade sideways. But this stock was gapping up 40%. That's a big deal. It had news. The price, $2.50. The float, 125,000 shares, has 177,000 shares of volume pre-market. This was one that we had on very close watch. Just from a purely technical standpoint, without even looking at the chart, it meets our criteria here for being gapping up more than 4% and for having a low float. Now to check the catalyst, I go over to marketwatch.com, I type in the symbol, or I can simply ask a trader in the room, hey, does anyone know if XYZ has news? So in this case, I'll just pull this up here and show you. And GBR ended up not being a very good trade today, which is fine. I mean, they're not all going to be winners, but it was the right stock to look at, and we knew it would be very closely watched by thousands of other traders because of the fact that it was at the top of the gap scanner. The next one down was PRTK, $24 stock, off the list. Don't want it. CYCC, gapping up 25%, $8 stock. That one looks good. So here we have GBR. Let's see, this is our marketwatch.com, GBR, and you can type the stock. You can click this little magnifying glass and search for a symbol. And then you can scroll down to press releases, and this was the release. It was actually after hours last night. Okay, so, and then, I do the same thing for for CYCC. Let's see, I just minimized a couple things there. Get the gap scanner back up. We do the same thing for CYCC. I check it. I know from a technical perspective it's good. 3.5 million share float, gapping up 25%. So then I check the headline. I go to MarketWatch. I see there's news, and I say, okay, that's what I wanted to see. I wanted to know that there was, some type of headline. All right. Next thing is check the daily chart. So again, on GBR or CYCC, we can look at that one first. The daily chart shows that we are above the 200 moving average, well above it, and we've got really no nearby resistance. GBR, same type of thing. We're opening up pretty high. We had this pullback. We've got room probably above the high of that candle, which is 254, and then that would give us room up to 379, the high of this candle here. So both of these were above the 200 moving average and had room. So decent looking daily charts. All right, so I mark out pre-market charts. If I notice any support or resistance pre-market, I'll start drawing that out. So again, here, in the case of CYCC, this one was fairly fairly active pre-market. And so I drew a line at the pre-market pivot right here, which was 262. And I drew another one at the pre-market high, which was 275. And then I drew a line at 250 because that was the half dollar. And I thought, okay, if this pops over 250, we might make it up to 262, and then from there to 275. Obviously, the bell rang. This was GBR, sorry. The bell rang and it sold off. Didn't end up working, but it just is the process of mapping out your pre-market chart. Here on CYCC, same type of thing. Here's the pre-market high right there, and that's about it. This one's kind of a little bit more difficult because it popped up, pulled back, dropped down, squeezed up, pulled back, and look at how wild this was today. $7 to 10.85, back down to 8, back up to 10, back down to 8. I mean, this is the definition of choppy. I only made $50 on this one today. I didn't overtrade it. It was not an easy one to trade. It just wasn't. It was just unpredictable. So, that's fine. You don't know it's going to be unpredictable until the bell rings and it starts trading. Although I suppose an early indicator was the fact that we had this big drop and then this squeeze back up. So in any case, when we go through the checklist, we're looking first at the gap scanner for stocks up more than 4%. We prioritize the low float stocks higher on the list and the stocks that are at the top of the gap scanner. Then we hunt for the catalyst, figure out what it is, earnings, news, etc. Number 4, we check the daily chart, and you could even check the daily chart before you hunt for the catalyst, because if it's a bad daily chart, you're probably not going to want to trade it, but you never know. So price should be looking to open above the 9, 20, and 50 EMA. It can be below the 200, but the 200 could create resistance. So if we open right below it, that's an issue. Mark out pre-market chart for support and resistance, and then we prepare orders to buy. So all we have to do when the market opens is press the buy button. And that way, as soon as the bell rings, I'm ready to trade. And that means if I'm watching a stock like GBR, and I know that I want to get in with 1,000 shares at 250, I'll type 1,000. I'll type in 250 right here, and then all I have to do is press the buy button. That's all I have to do. And you can see here my order at 250 went through because that was a limit order, and the price right now is 198. So if the market opens at 240 and we pop up to 245, and we see lots of volume coming in around 246, 247, we could think, you know what, I'm going to take half size. Maybe I'll take 500 shares or 400 shares at 48. If we get the break, I'll double. We get, that break over that level. First target now, control P, sell up 10 cents, 260, 270, and start taking some profit. All right. So, anyways, that's basically my process. And then what I'll do is if I'm watching 3 stocks, if I've got 3 different stocks on watch, I'll have 3 different level 2 windows, one for each one of those stocks. So I've got one here and one here. And then I can prepare my order for each one. And I can put another one, let's say, over here. And then I could put another one right down here. All right, so, oops, well, whatever. You get the idea. So there we go. So now we've got 4 level 2 windows. And this is literally what my platform looks like. I have 4 windows side by side at all times. And my other monitor has the charts. So I don't even use charts for Speed Trader. I just have the level 2 windows side by side. And then each morning I'm prepping the orders based on some of the levels I'm seeing pre-market. Now I'm going to go through the 4 or 5 different setups that I will trade the gap and go strategy on. That's when we are applying the patterns. But right now I'm just kind of showing you my process for selecting gap and go stocks. So I select the gap and go stocks, and then right in this area is where I type in the potential entry. So finding the potential entry is going to be the next thing we look at. Now, if a stock has a really big float or it has too much pre-market volume, like 2 or 3 million shares, it'll typically be more difficult to trade when the market opens because essentially it's already trading as though the bell already rang. It already has a lot of volume. I'm the last one to the party, and I want to be one of the first ones to see the breaking news and to get in on that opportunity rather than be one of the last ones to arrive. So I get all my gap and go strategy stocks from my Trade Ideas Gap Scanner. And as I said, ideally, I want to see a stock gapping up between 5 and 10%. And even if it's higher, that's okay. But I want to see that it's consolidating in the top of the pre-market range. So if a stock yesterday was trading at $2 and it gaps up to 3 and then pulls back to 220, it pulled back, 80% of the gap. I don't like that. I'd rather see it at a minimum hold 50% of the gap. Whatever the gap is, and we may have a pre-market high that's really extended and we may pull back. The pullback is okay. Pullbacks are buying opportunities, but I don't want to see it pull back more than 50% of the move. Because if it does that, to me, it's just showing weakness when we continue to pull back lower and lower and lower. In a moment, I'm going to show you examples of good pre-market charts and bad pre-market charts. So ideally, we want a stock that actually is forming a bull flag or a flat top breakout pre-market, because that's a chart pattern we're very familiar with. That's going to be a great opportunity for us to take a trade. On average, I can find 2 to 4 gap and go candidates each day. And if I don't have any good candidates, any good setups, then I'll just be cautious and I may not take any trades. So this is another day, just a typical gap scanner. This one was a little bit on the lighter side. There were only about 10 or 12 gappers. The biggest gapper was up 13%. And that's definitely in contrast today where we had gappers in the 30s and 40s in terms of percentage gap. So CDTI, it was gapping up 13%, 43,000 shares of volume. Now E-Day here says number of days away from earnings. If a stock is within 1 day of earnings, then you know that the reason it's gapping up is because they just came out with earnings. If they're 17 days away from earnings, then you know that that's not the catalyst. So this immediately will tell me if the catalyst is earnings. And that's the only value of this column right here. The other columns, relative volume in the last 5 minutes, anything above 100 is significant. When you get into 500, 900, 1,000 or higher, there's a lot of volume. Relative mentions on StockTwits tells us if the stock is trending on social media, which may or may not be super, super relevant. Okay, so gap and go, choosing the best stocks. I select stocks I'll use for the gap and go strategy based on the size of the gap, the catalyst causing the gap, how familiar I am with the stock. In other words, is it a former runner or is it a stock that's recently been really difficult to trade or whatever, and the amount of pre-market volume. I always mark out the pre-market high and the high of any pre-market consolidation. So if we have that gap where we squeeze up to here, we pull back and we consolidate here, I'll mark out the top of the consolidation line in addition to the top of the actual gap. Now remember, the reason the gap and go strategy works is because thousands and thousands of other traders practice a variation of this same strategy, right? Or, well, that number one, and then number two, anyone who is short the stock from the previous day, once the bell rings, their stop orders will go through. Stop orders do not go through pre-market. They go through once the bell rings. So the bell rings and suddenly the stock is up, boom, there goes a stop order, and that is a buy order for anyone who's short. So all of those buy orders can start going through automatically, and if they're market orders, then the stock can really squeeze. It can really take off. Now, you have to think that when we have a stock on the gap scanner, it's kind of like the new jungle gym on the playground, and everyone wants to get a piece of the action. Everyone wants to see it. Everyone wants to play on it and have some fun. When we see stocks gapping up, you kind of have to think about it like that. So the biggest gapper with, the most exciting headline is usually the one that everyone's going to be looking at. When you have a day where you have 5 new jungle gyms all coming out, 5 stocks on the gap scanner, sometimes none of them get a lot of attention and none of them get really good follow through because there's too many choices. We usually do better when there's only 1 or 2 obvious setups, because if it's obvious to us, it'll be obvious, of course, to thousands of other traders. So this is an example of a decent pre-market flag. The stock popped up, not a lot of volume, but it's up, consolidating sideways. And so what would be our entry point on this stock? you can see the pre-market high is just above 350. It's just above the half dollar. So one of the things we talked about is that when the resistance point is just above the half dollar, we'll sometimes enter at the half dollar because we expect when we break over that level, we'll almost definitely break through the second resistance point. So the entry here would be at 350, and this stock went from 350 all the way up to $5 right in about, let's see, 3 minutes. That right there is an opportunity. That's a huge opportunity. That's a really big move. The first 1 minute pullback right here ended up being a false break. Now we popped up, we made new highs by like 2 pennies, and then we rolled over pretty quickly. This is another example of a good pre-market flag. We pop up, we consolidate, we're kind of holding right around that 50% mark. The low of the gap is down here, so we're kind of, right around sideways. It looks decent. This one I would be watching for a curling action over $2. Knowing the pre-market high is like 205, I would probably get in at that whole dollar resistance point, expecting that as soon as we break that level, we would break pre-market highs. This is a higher price stock that shows you that same pre-market flag, the pop up from $14 all the way to 20, consolidation between 18 and 19 pre-market, and you kind of see I mapped out the high of the consolidation at 19 because I know when it breaks over that level, it's breaking over the high of consolidation plus a whole dollar. There's a good chance it'll make a move. My first target would be a move back to high of day. This is an example of a bad pre-market flag. This is a bad flag because we gapped up to 220 and we've just been selling off ever since. We've just been slowly, moving back down towards yesterday's close. So this is not a good gap. This is not a very good gap either. We gap up and we pull back. Now you could say this is holding the 50% gap in terms of, from $1.40 to $2, but the chart itself is trending down. So that's not what we like to see. We want to see that we're holding really above the 50% line. And if this consolidated right here at 190, that would have been fine. It was the fact that we broke down here that really broke the pattern. And then of course the bell rang and we sold off more. This is another bad pre-market flag. We were gapping up. We've got an 11 million share float, gapping up 11%, 400,000 shares of volume. We pop up to a high of 190 and then, selling off. Let's see, was that the same one? Yeah, it was the same one. I guess for some reason I added it twice. Another pre-market flag. Now this one's interesting because you've got pre-market consolidation, the first pullback, and then you move higher, and then you've got the second pullback, and as soon as the bell rings, we squeeze up. This can be a little bit tricky, but because you have this one red candle here, you've got a little bit of a rest. When you have stocks that are extending and getting really kind of squeezing, but right before the open, it can be harder to manage risk because you're buying into a squeeze. So it's nice when you get one candle of pullback the way you had here. With that said, the pre-market high was $20. So as soon as you got in, breaking 20 would have been a potential entry simply for the break of pre-market highs. You just know that this is a little more extended, so the risk is a little bit higher. And then here we went from 20 up to 21, 22, and $23. I mean, that is a big move for sure. This is another one where you had the first pullback and the second pullback pre-market. And so by the time the bell rang, it was like, all right, this thing's already really extended. We're on the third pullback, and guess what happens? The bell rings and it sells off. Too extended. We'd prefer to have the market open right here after the second pullback. And again, this shows you why sometimes trading pre-market, could give you that opportunity, but look at this candle wick. This candle went from 13 all the way down to 17. That's risk, right? And that can happen pre-market. I mean, it really can. One seller can bring a stock down 3, 4, 5 points. It can happen so fast. So that's why I don't trade pre-market. Here's another one that was extended going into the bell, and it basically just kept squeezing up. You had a little flat top breakout pattern here with 1, 2, 3 taps at 320, broke over that level up to 340. You have this red candle, a little pullback, and so the pre-market high was 358. And I did take this trade. I got in at 358. We popped up in this 5-minute candle from 358 to 385, and then we rolled over. That was still almost 30 cents of potential, 20 cents of potential, which, for me was a scalp. I got in quickly, I got out quickly. I got in, I sold half up 20 cents, set my stop at break even. As we came back down, I got out of the trade. But it's not the strongest setup, and it's not one I would be especially aggressive on because it was already so extended pre-market. We weren't buying a well-defined flag. This is another one that was really extended pre-market. The move continued after hours. I've said this before, I always prefer to trade stocks where the move starts pre-market. When the move continues from after hours, this basically right before the close squeezed from 250 up to 3. We pulled back and then we squeezed up to 350, back up to 450, back or up to 450, and then we opened right around 5. I missed the party. I missed the whole move. And so by the time the bell rings, it's already too extended. So it becomes really difficult to trade these on a gap and go trade or gap and go strategy setup when the move starts after hours. It's much better to trade a stock that's gapping up in the pre-market session, and that's when the pattern is beginning. So a gap and go strategy, how to trade it? Well, you know how to make the watch list, and you already know the right type of stocks to trade, and I've sort of broken down how to find the gap and go stocks each day using the scanner and then looking for it to meet our criteria. It's got to be, a stock in play. It's got to be a gap of this amount, 4% or higher, 5 to 10% is ideal. You want to have a good pre-market chart, etc. When the market opens at 9:30, like I said, I usually have my order ready to go to buy the gap up stock at pre-market highs. So I put my order at pre-market highs. Now, even if I want to buy it before it hits pre-market highs, that's fine, but I have my order up at the top because I know that's the most I would really ever be willing to pay. All right, so I'm looking for an immediate push through pre-market highs, which is where I would buy, and then a continued squeeze. Stock can gap up 10% and then squeeze 15, 20, 30% as soon as the bell rings. That squeeze, for me, is the opportunity to capture profit. All right, and remember, we still have to refer back to our 2-to-1 profit-loss ratio. So if you are thinking 20 cents is your target, 10 cents needs to be your stop. So this is my order entry window on DAS Trader. So I could prepare my order here, 2,000 shares. I could type in 519, maybe put it up at 520, etc. And all I have to do is press the buy button. So I have 4 windows just like that prepared. If I happen to have 4 stocks on watch, I never have more than 4. So 4 is the max. And sometimes I only have 2. So today I had GBR on watch over 250, and I had CYCC on watch, and I had DFFN on watch. So I had 3 on watch this morning. DFFN was over, I think it was 450. And CYCC, I didn't really have a spot in mind. I just kind of had an order at 9, depending on what it would do. Okay, now let's see, back this back up. All right, so the charts that I'm looking at, Howard, when we're trading right at the open, I'll be looking at the 5-minute and the 1-minute. But the pre-market chart I'm usually looking at is a 5-minute chart, but it doesn't really make a big difference. If we see consolidation on the 1-minute, we're most likely seeing consolidation on the 5-minute as well. So as long as we see a little bit of pullback on the 5-minute, it's usually fine. And then once the bell rings, I'll be looking at both the 5-minute and the 1-minute time frame. So these are the 5 entry setups for taking a gap and go trade. And Matt, to answer your question there really quickly, if you have 4 windows prepared and you wanted to use your hotkey for buying 90% buying power, then you basically would just have the level 2, typed in, the symbol typed in for these 4 stocks, and you would press your hotkey as soon as the bell rang. So you may not actually, you press the hotkey and you say okay, you may not end up using the buy button. But on the other hand, you could kind of, since you have time pre-market, calculate, well, what is 90% of my buying power on, this stock at this price, and, sort of type in, well, it's like 1,250 shares. But either way you wanted to do it would be fine. It's just whichever felt, I suppose, faster. So these are the 5, not 4, 5 unique setups. These are 5 entry opportunities. Each has a predetermined stop. Number 1 is the break of pre-market highs. The entry is on a 1-minute time frame. Now, you're looking at the 5-minute, the pre-market high is the same whether it's a 1-minute or a 5-minute chart, right? Pre-market high is pre-market high. But the entry is going to be using the 1-minute time frame. So 1 minute and 5 minutes side by side, but looking at the 1-minute chart. Number 2 is a break of the pre-market pivot. And this is the new one that I added that brought it from 4 to 5. And I'll show you that. Entry is on the 1-minute chart. Number 3 is a 1-minute opening range breakout, which I'll show you in a moment. Number 4 is the first pullback, which works on both the 1-minute and the 5-minute time frame. So if you missed the first move, you can buy the first 1-minute pullback, which is a bull flag, hopefully, or a micro pullback, or you can buy the first 5-minute pullback, which should be a bull flag. Number 5 is a red to green move, and that's typically traded on the 1-minute chart, but also works on the 5-minute chart. The hard stop on these trades is 20 cents. You should never lose more than 20 cents on any of these trades, because if it's down 20 cents, you're wrong about your entry. It was a bad entry. So you just take the loss, and that's what I do. If I'm down more than 20 cents, I bail out. Occasionally, I'll lose more than that, but 20 cents is a hard stop. A profit target is 20 to 40 cents. Obviously, if I'm looking at a stock that's $8, 20 to 40 cents is more realistic. If I'm looking at a stock that's $1.60, 40 cents, that may not be realistic. That's a pretty big move. So maybe on that stock, I figure it'll be 20 cents, and now I need to use a tighter stop of 10 cents to give me the 2-to-1 profit loss ratio. So a break of pre-market highs looks like this. This right here, this yellow line, is the pre-market high. The stock popped up and it pulled back a little bit. This is a bull flag. Now, sometimes when you have pre-market flags like this, you will have a candle that made a new high and kind of broke the flag. If that's the case, my entry would be simply the break of pre-market highs. So if we say this is $2, the entry would be right here at 2. If I got in right here, this would be buying what I would call the pivot, and it would be, in this case, the way this candle is drawn, it would be the apex point of the bull flag, which would totally be okay. That would be a fine entry in this case. But if you had had a couple fake outs pre-market, you may not trust buying this spot because it may not look so clean. And in that case, you'd probably prefer to buy pre-market highs. Okay, so pre-market entry there, your stop is 20 cents. So wherever that is, that's your stop. Profit target at this point is simply to try to get 20 or 30 cents of profit, knowing that stocks that gap up often squeeze up. When you're taking a trade based on entry setup number 1, you're buying the break of pre-market highs. It is my favorite gap and go strategy chart pattern. The time frame, 9:30 to 9:45. So remember, you've got, this is kind of you're setting up your folder. Think about it like this. You've got your folder. You've got the gap and go strategy, which obviously you trade from 9:30 to 9:45. Within that strategy, you have these sub strategies. These are the actual setups that you take. So buying the break of pre-market high is traded from 9:30 to 9:45, best on low float stocks, but works on all floats as long as there is high relative volume. Your stop loss is the low of the last 5-minute candle, or arbitrary stops at 5, 10, or 20 cents based on whatever your realistic profit target would be. So if your profit target is 10, 20, or 40 cents, you use half of that amount as your stop. The range today ideally should be up already at least 10%. I enter these trades with limit orders prepared at the pre-market high, and then I press the buy button when I'm ready. Sometimes I will watch the pre-market high and I will press the buy button once, and if I don't get filled because it popped over my limit, in that case, I will use Shift 1 to use my hotkey to get in. Now, if I do that, I'm paying a higher price and I'm chasing it a little bit. I'll only do that on a stock that meets like 5 out of the 6 of my criteria for being a home run stock. The requirements of this setup is that the stock should have a catalyst or be a former runner, but technical breakouts are okay. Price range preferred between $1.50 and $10, applicable on all prices. Higher price stocks, 5-minute patterns only. Okay, so if the price is above $10, I use 5-minute patterns only. How do I find these stocks? You find them with the gap scanners, which will show us the stocks gapping up more than 4 or 5%. And then we'll find the pre-market highs based on the pre-market chart. This is my order entry window. I enter here, simply use hotkeys. Now, my hotkey right now for Shift 1 will buy 2,500 shares with a limit order, offset 5 cents above the current ask, which allows for some slippage, but it's controllable. Now, when you enter these orders, you can choose to use, if you're using Speed Trader, if you're using Lightspeed, or if you're using Interactive Brokers, you can direct route to an ECN. You could use ARCA, you could use EdgeX, you could use NASDAQ, you could use BATS. Any of them would be fine if you use the standard limit, which is the only route that's available at SureTrader. If you just use the standard limit, you're using smart routing. Sometimes smart routing is just as fast as direct routing, but I always prefer to use direct routing. It doesn't really matter which direct route you use, but usually a direct route will be faster than a smart route. Okay, so you could, when you click on this, remember you get that drop down that gives you all of the available routes, and that's where you would choose one of them. And then whichever one you choose, if it works, just keep using that one. I will sell half when I hit my first profit target, which is usually 20 or 30 cents versus the 10-cent stop. That's the 2-to-1, 3-to-1 profit loss ratio. And then I adjust my mental stop to break even. If the stock comes back to my original entry price, I'll sell the rest. Now, there are two things that I can do for you guys. Number one is in the simulator, remember how I showed you that when you get into a trade, you can get in using, let's say, Shift 1 to buy 1,000 shares. And then you can press a profit target by pressing Control P for profit target. That'll sell half of your position up 10 cents. Control bracket, the button right next to the P button, is going to sell another quarter up 20 cents. And the other side of the bracket, the button 2 keys over from the P button, will give you another 25% of your position out 30 cents. With these 3 orders, you now have profit target 1, 2, and 3. As soon as you get into the trade, and you can press Control T to set your stop. And just like that, you've got the order set up. Now, during our lesson on hotkeys, which is chapter 10, I'm going to share with you some scripts that you can use in Dash Trader to do all of that. Well, it's not exactly that, but to do something like that with one keystroke. That hotkey script, you'll send the buy order, and as soon as your buy order is sent, you will put out a stop and you'll put out a profit target. Whichever one hits, your order will sell 100% of the position. Now, this is a little bit of an interesting topic because I think it's great to put out the max loss, but I don't like selling my entire position at a profit target because if I sell the whole thing up 20 cents and then it goes up 80 cents, I'm going to be like, dang it, I just capped my winner. At the same time, some of you may prefer to do that, especially if you're trading with SureTrader where the commissions are really high. You may say, you know what, I just want to take 10 cents every time and just do that, 3 times a day, take my 10 cents and do that until I build up the account. And so that would be fine. The other type of hotkey I'll share with you is one that you press the buy button and you immediately have a 10-cent stop. In one keystroke, you have both orders that get fired. The other one, you press the buy button and you immediately have a 20-cent profit target order out there. You don't have a stop order, but you have your profit target order, but it'll sell the whole position. And then the fourth one is you press the buy button and you immediately have a trailing stop order that's now sitting behind you. That's the one that might be the best because it'll allow you to maximize on the potential move and it protects you from losses. So I'll be sharing those scripts with you guys in class 10. But for right now, just know that I don't use any of them. These are only for your benefit. I don't use them. When I get into a trade, I press Shift 1. When I see I'm up 10 or 15 cents, I go and I try to sell half my position on the ask using my hotkey, or maybe I sell half of it on the bid just to take profit, sell half like that, it's gone. If it comes back down to my break even, my average price is 206, I'll sell the rest. If it keeps going up, I'll sell another quarter, or sell another quarter until I'm down to almost nothing, and then I'll sell the rest. All right, and like Elio said, 15 cents on 1,000 shares is 150 bucks. If you could do that 3 times a day, I mean, that's not bad. So that would be the benefit of using a range order. But again, if that stock that you sold for 15 cents ends up going up 40, you will feel annoyed, and you'll never get a big winner using that type of stop order where you have a max profit target and a max loss. So in any case, that's something just to give you sort of a preview of what we'll be talking about in class 10. But for right now, my process every day, even just for myself, is to enter the share size, to type in the price based on the pre-market high for the pre-market high setup, and then I press the buy button as soon as the bell rings. All right, so now I'm going to show you a video of me trading on a Gap and Go stock. So this is PULM, and I've got several videos queued up here. So let me back this up and we'll watch this. All right, so I'm going to go full screen. Make sure I'm HD. Okay, so on this this setup, I've got PULM right over here, and so I've got PULM on watch, I've got staff on watch. Actually, this one's not even on watch. This is just the stock that was on my platform when I turned it on that morning. So PULM is the one on watch right now. I've got it set up here for a Gap and Go trade. Let's see. This one, CEMP, that I have over on the side, was trading with a 5-cent spread. So remember how some of these stocks trade with 5-cent tick, and we'll talk about that later in the course as well. I don't trade stocks that have a 5-cent spread like this, where every quote is in 5 cents. I don't trade them. So that's why this one, even though CEMP was on the Gap scanner, was not on my watch list. So let's zoom forward here. So we're at 926, and let's see. You can see a stock has 5-cent tick just by pulling up the level 2. You'll see every single quote has a 0 or a 5. There'll be no 18s or 19s or whatever. It's all 0s and 5s. All right, so we're about a minute away from the bell here. So pre-market high is 434. So notice here how I type in my order at 440. And let me just, I'm not sure if this is giving you guys HD. It is, it just doesn't look that great. Anyways, I upload all of these videos to the class. So, and I'll continue to upload new videos of new examples so you guys can watch them there as well. But hopefully you can see this reasonably well. Okay, so I've typed in 440 right here. We've got 30 seconds before the bell rings, 2,500 shares. The pre-market high is 434, so I'm giving myself a 6-cent offset. I have PULM on 2 level 2s, but I'm really only have 1 ready to go. And you'll see this will be a very quick trade. 9 seconds to the bell, 8 seconds, 7, 6, 5, 4, 3, 2, 1. 28,000 shares so far. And see, okay, there was a seller at 420. You saw that seller at 420? I have a pretty good feeling that if we see buyers come in and that guy gets taken out, we will pop right back up to our pre-market highs. So I'm just sitting, I'm just watching. And here's some volume coming in, 16. See, 16,000 shares, 17,000 on the ask. We're going to watch that start to drop down, and that's when I'll press the buy button. 17, 16, 15, 14. Okay, we're watching it. I've got my order ready to go. I'm just waiting to see some buying. 15, 8, there we go. I jumped in 5,000 shares at 21, and now suddenly we're up $260. 28 on the bid, 29 on the ask, 30 on the ask, 34 on the ask. I'm up over $500. I put out an order to sell half at 435 on the ask. I sold another quarter on the ask, 35. I sold it because we came up and hit pre-market highs. We double topped at pre-market highs. I want to see these break pre-market highs. My first target really for a home run setup would be that this had gone right up to 450. So right now I'm still holding 1,200 shares. I've locked up $470 in the first minute and a half, holding 1,200 shares with a stop at break even. Now I was using a chart over on my other computer, and then I just updated it here. So there we got the move up, a little bit of a pullback. My hand is on the trigger. Check out the daily chart on this one. See how I'll pause, well, I'll let it go. Daily chart is opening up above the moving averages. Room back up towards 5 or 6. So this 1 minute candle ended up being a doji, which is not what we like, right? Not ideal. We'd rather see clean, just a clean squeeze, but here's 36. There we go. 38. Let's see, what are we going to do? Kind of seems like we're stuck here at 38. A lot of buying, but it's not moving. You know, kind of a little iffy there. That's sort of what we would call a hidden seller, because there was buying going through, but the price isn't moving. So I'm up 165 unrealized on the 1,200 shares, and I want to see this break, you know, over 440 and go to 450. I mean, that's $0.50. So, you know, you kind of had some accumulation there, a little bit of a pullback. So right now we've got 3 green candles, and now we're starting to get a rest candle. We haven't had a 1 minute pullback yet. Now, having said all this, $470 in 3 minutes is not bad, right? That's the daily goal for a lot of traders. So I'm watching this to break over 38. That's kind of our little resistance point for some reason. I look here and I see that, there we go. There's 39, there's 40. So kind of strange that we broke resistance only by 2 pennies. There's 41, 43. Here's a little more volume. 45 on the ask. Now I've got 240 unrealized profit. I'm up 20 cents. But I know that we're going to have a little resistance at, oh, now hold up. Hold up. Look at that. What kind of seller is that at 450? That's a 43,000 share seller. That is not what I like to see, right? Daddy doesn't like to see that. 40,000 share seller, that's someone putting like the ceiling on this stock. So when I see that, I start to think, you know what? It's not looking good. I was able to sell 500 at 46 or 440, and I sold the rest. So $722 profit before commissions. And really the big exit indicator on that was seeing a big seller pop up here at 50. Let's see, let me back up. The seller at 50 right here, the 44,000 share seller, that guy was the problem. Now, the green orders here on the time and sales are orders on the ask. Red are orders on the bid, and white are orders that go through in between the spread. So they're kind of like neutral. So in any case, this is a stock with a good daily chart. Low float with a catalyst, gap and go setup. Entry was in anticipation of the break of pre-market highs. Now, because we opened a little lower and we saw that we had that seller at 420, I figured as soon as that guy moved out of the way, we would probably pop up. We would get a little bit of a move, and that's exactly what happened. Blue are unfilled orders. I'm not sure where you see blue on this. The red is an open order that I have right here. Green is my current position. The level 2 down here, green is our current tier, our current best bid and current best ask. Red is one tier down, so 42. Blue is another tier down. So these are orders that are sitting there pending. They're unfilled orders. Yeah, they're just sitting there waiting for someone to come and buy or come and sell. So I started this trade with 5,000 shares. All right, so we'll just kind of rewind this for a second, go back to just before the bell rings. So bell's about to ring, I see it pop up, the bell's, market's open, and I'm watching for that seller, that 17,000 share seller to move. I know this is a strong stock with a history of making big moves. When I see buyers come in, I hit my order and jump in. And watch, I'll press the button twice. Once and then twice. No confirmation, the orders just go. So I see that 17,000 share seller. 15, there we go, very quick, jump in. That's how quick you can capitalize on these opportunities. Now, of course, if you're late, you're getting filled at 28 or 29, which is certainly a risk. So even though I was able to book the majority of my profit in the first minute, basically, I continued to hold it for the move higher. I never had a stop order on this trade. I never had a live stop on this trade. I was just holding the position. But the thing is, all I have to do to sell is press the control button and the Z button. Bail out, control Z, that's it. I press those two buttons and I'm out. Just as fast as I got in, I'm back out. So unless I, lose internet connection, or faint, pass out at my desk, I'm in control. And, those are two risks, I suppose, but, for the most part, it's not an issue. And I've got the phone number of my broker written down on my laptop anyways, in case I need to make a call. Okay, so that was the first example. As you can see, we're going to have many more examples. These are just the ones that I've uploaded there. There's others in another place. Okay, so setup is a break over daily resistance levels and in anticipation of breaking pre-market highs. And yes, you can turn off the confirmation in Fantasy Stock Traders just simply by going up to Tools and uncheck Ask for Confirmation. And then you can get into this as quickly as pressing. Click once, 400 shares. Click twice, 800 shares. 3 times, 1,200 shares. Control Z, I'm out. That's how fast you can trade with real money or with simulated money. That's how fast the orders will process. Okay, so again, you're sort of seeing a real-time example of the potential. This is the potential if you can follow a set of rules, if you can understand the right entry points. So this entry point that we're talking about is a break of pre-market highs. This is a just a regular slide. Pre-market high here was 369. Okay, market opened, we dipped down, we opened at like 360, 358. As we popped up, I was like, okay, looks good. I'll get in for the break of the pre-market highs using that same process. Now, if I had seen a 20,000 share seller at 369, I would have said, let me wait a second, let it start to thin out. Goes, 17, 16, 15, 14, 13, and then I jump in, it pops up, and we got this move from 369 up to $6.08. Now, I wasn't even trading with big size on this one. I mean, it's kind of pathetic when you think about how big of an opportunity that was, and I only made 1,200 bucks. 72% of the traders in the room on that day, which were 160, or well, no, I guess we had 220 or something, but 166 of them were profitable on that trade. Here is another video. These videos are all based on sub-strategy number 1, break of pre-market highs, and we're going to have videos for all 5 of these strategies, okay, sub-strategies. So here we go. So on this one, let's see, I'm watching, I don't have notes. Why? I took away my notes for some reason. So this is anyone's guess. Looks like we've got AKAO here. So this might be the actual trade on AKAO. And this, by the way, says simulated trading because this is Thinkorswim. I'm logged into Thinkorswim for my free charts. Remember how we talked about how you can get free charts? Um, this is separate from the Speed Trader platform, which is on the left. These are two platforms side by side. Okay, so I've got my order ready to go. I'm not sure exactly what we're doing here. Let me just fast forward a little bit. Interestingly, on this one, for some reason, I really like hesitated big time. I don't know why I ended up getting in as high as 488, but here you'll see I'm about to get in at 488. I guess I'm getting in anticipation of the break over the $0.50 or over the whole dollar, which is a $5 break. So we pop up to 488, and now see how the price is pinned at 513 and 517 and orders are going through? This stock is about to get halted on a circuit breaker. It's up 60%. So that's why I didn't do as well on this stock. I got in it super, super late. I don't know why I wasn't in it sooner. So now it's halted. Remember that these will be halted for 5 minutes. This is a circuit breaker halt. Okay, the volatility halt. All right, so we'll be halted for 5 minutes. So let's fast forward. Okay, so this is the chart. This popped up from 360 pre-market up to 513. Oh, this was actually, I think, a different day. In any case, AKO is a former runner. It's a stock that's had a history of making big moves, and we've seen this happen on several occasions. Okay, so we're about to resume pre-market high, or the high before the halt is 513. I've got an order ready at 551 to add for the $0.50 break, and there we go. I added for the $0.50 break. So this is one of those times like OPTT where I am simply entering these stocks at $0.50 and whole dollars, which is without a doubt high risk. I added again at 90 in anticipation of the break over $6. That is high risk without a doubt. And right now I'm down, $800 on this trade because my average is 560. I was expecting that this would break over $6. There's $6 on the ask, 602. Got an order to sell at 608. I sold half of it and made $1,000. Sold another quarter, locked up another couple $100, and I'm scaling out of the rest. So this was a trade where I really, it's easy to say this in hindsight looking at it. I was pretty aggressive on it, but knowing the stock was a former runner with a history of making a big move, like that stock OPTT, I was more inclined to just simply jump in the for the momentum at $0.50 and whole dollars. So this one actually is kind of miscategorized here because this is not a break of pre-market high. The break of pre-market high was down here at 374, but from that point we went all the way to a high of 608. Which was definitely a pretty big move. So yeah, I guess this was the stock I made $1,280 on. So nothing super impressive considering that move. I'm not that excited about that trade. I'm not sure what setup this is on OPGN, so we'll just skip it. All right, so let me back out of that. Oops. All right, so that one was AKAO. So here's another one, JVA, break of pre-market highs. This one had very light volume. Pre-market high was 430, but there was news on this day. So when I saw this, I was like, look, this is a stock with low volume, with low float, and it has a headline. So it's the type of stock that's worth watching. And look what happened. It broke 431 and went all the way up to 615. So on this one here, we've got live trading example. So let's see. This is JVA for the gap and go trade. So there's the bell that rang. Right now, we're at 437 by 445 with very light volume. And I'm thinking, okay, well, the pre-market high was 431, so we're already a little above that. And there I got in at 448 for the $0.50 break, and then I added at 459, which was essentially being aggressive. I mean, it brought my average up to 455. That was one of those times that I mentioned adding into a squeeze. I sold half at 550, sold another quarter at 528, another 29 shares at 507, and I'm all out. So right there, a gap and go trade from 450 up to 5, based on the fact that this stock was gapping up with a catalyst, got in for the $0.50 break, got the move up to the next $0.50, whole dollar. I was looking for this to break over the $0.50 of 450. So it was the $0.50 break that I was looking for. And as soon as I saw a little bit of volume coming in, I jumped in, and then we got that quick squeeze, which is not surprising considering the fact that this was a stock that had a headline, and was had a low float. So let's see. All right, this one is a live trading example of IG. This is, again, Thinkorswim on the left and my SureTrader account on the right. This was from last year. So the market's about to open in 30 seconds. IG has a pre-market high of 485. So I'm watching over 485 for the break of the pre-market highs for my entry. Now, the last trade on GVA, the pre-market high was 430, and it opened a little higher, so I waited for it to break over the $0.50 of 450. It was getting in a little higher, but it was the psychological level. So now here we go. The bell just rang. Pre-market high is 485. So 485 is an entry point based on pre-market highs, but we know it is extended, so the risk is a little higher on this one. It's not a really super clean pullback. Okay, so there we go. We've got IG. So I'm jumping in there. Let's see, where did I get filled? Back up. I jumped in at 77 and 76, simply in anticipation that once we broke over 85, the logical target would be $5, right? And that makes sense. Once you break over a level like 85, the logical target is the whole dollar. Once you break over a level like 425, the next logical spot is 450. So I jumped in 3,600 shares at 476. Target is $5. This clock is part of the DAS Trader software. So I'm looking for the break over 5.99 on the ask. There we go. And now there's two things I could do. When a stock breaks through like that, I can put an order on the ask, which I did. I put one order at 510 right here to sell on the ask, to sell into strength. And I put another order right here at 506 because that first order didn't fill. So I put two orders on the ask. Alternatively, I could sell on the bid right now and get sell at $5. But if I sell at 506 or 510, I'm getting a better price. So, but there's the risk. See how quickly it suddenly dropped. Oops. See how it suddenly dropped down to 490 there just for a second. So zoom this back forward. So here we go. There's the break. 510. It looked like we were going to break over 510, but then we couldn't. So kind of deciding what am I going to do, I decide to sell on the bid. I take the profit. It ends up, that I gave back some profit because I sold at 501, 496, and 493, and I'm probably going to end up selling the rest, at 485. So it didn't end up being as big of a winner as I would have liked, but, it was a winner nonetheless. $656 in the first 2 minutes of the day. So what I'm looking at here, the levels in play are pre-market highs and half dollars and whole dollars. All right, let's go to the next slide. Next slide, this is LEU. At least I think this is LEU, or this may be ASCT. I'm switching orders from selling on the ask to selling on the bid simply by using hotkeys. So ASCT right here, this is a stock that squeezed from $1.60 all the way up to $3.15 in the first 30, 40 minutes of the market being open. So that was a really big move. This was a strong daily chart above the moving averages, which looked good, gapping up and then squeezing higher. So as I saw it hitting the scanners, I jumped in this at $2. So getting in up here at 2 was getting in for the break over the whole dollar. It was a little extended, but that was the setup there. All right, so I put my order out to buy 2,000 shares at $2, and we have it right here. We've got $2 by 20. Right now we have 202 by 203. So this is an example where I only filled 600 shares, which is just super, super annoying. So I've only got 600 shares. And this was the very beginning of my small account challenge at SureTrader last year. I only had $5,000. So I took the $60 profit, and now I'm going to wait for my next entry. So let's zoom forward here a little bit. Pull back. So right now, this is kind of that period where we're consolidating. We've been consolidating around 210, 215, and there I jumped in at 220, and that's this candle here as it broke over. So this was that one kind of resting candle, not the perfect resting candle, but just a little bit of a momentary pullback, and then that pop up, and from there we squeezed up to $3. See that big bid right there? That's what we like to see, the 23,000 share bid. That's showing a really big buyer. Now we want to see the break over the half dollar, over 250. Over 250, next target, 275, $3, going in kind of 25-cent, 50-cent increments. My average right now is 220 with 1,015 shares. I also have an order ready at 250 to add to the position because I think if we break over 250, this stock is already up, 50%. If we break over 250, we may squeeze all the way up to 3. That's when you start to realize, look, this stock just went from 2 to 250. It's showing some real strength. So I'm just watching this, waiting for that opportunity. I've got my hand hovering over the buy button. My order is prepared at 250 to add 1,000 shares. I want to see the buy-in coming in, and then once I see it, that's the moment where, right there, boom, I just added, and look at that pop. So now I have 2,000 shares with a 230 average. My average is higher, but I have a bigger position. And now as it starts to move up, I certainly have more potential. I sold 700 shares at 65 and 400 at 54 to try to scale back my risk a little bit. And now I'm holding 915 shares, same price. I'm just sort of watching. I've got an order out at 60 something right there. 61, I think it is. Now you can see by the time this gave us a 1-minute pullback, it was already fairly extended. It had already gone from $1.50 or 60 up to 280. So this 1-minute pullback was kind of a false break, and then the second one kind of worked, came back down quickly. So the best opportunity on this one was getting in early in this move at either $2 for the whole dollar break or $2.50 for the half dollar break. All right, so let's see. So that's that trade on ASCT. Now, buying the pre-market highs on the 1-minute chart, buying the pre-market highs for a high day squeeze is one of my favorite strategies, but it requires a good pre-market flag. So this is the case of CDTI where we have that pre-market flag here of 251, this little consolidation, the pullback, the entry is at 251 for the break of the pre-market highs. Here's a break of pre-market highs. The pre-market high was $4, which is also the whole dollar. Now, just before the bell, we popped up here, and it looks like we broke that level. We pulled back, and then when we squeezed up through 4 and over the pre-market high now of 4, maybe 17, that was the entry. And from 417, we went up to 440. We pulled back, and then we went to 460, up to 480. 1 minute micro pullback right here gave you an opportunity to get in at 480 for the move up to 510. And this is where some traders would only take this trade if they missed the break on the pre-market highs. So the two trades on this one would have been first, buying the break of pre-market highs, knowing that this is a stock that meets all of our criteria. Remember, I know we're looking at the details, but I don't want you to lose track of the big picture. We're looking at stocks that all meet our criteria for being stocks in play. And then it's just finding an opportunity. Knowing that these are strong stocks that have a great chance of making a 20-30% move, what's our best opportunity to get into it? It could be a break of pre-market highs. It could also be an entry right around a $0.50 or a whole dollar, given the fact that these stocks are so strong. We just have to be careful about buying when they're really extended. So getting in this one at the $0.50 up here at 450, by this point, it would have been tricky because it's like, well, it's already up 50 cents. And I've done that before and it comes right back down to 4 and you're down 50 cents. Look at this one. Pre-market high was $3. The bell rang. We kind of were sideways for a second and then all of a sudden, boom, we go through the pre-market high. We break that high of $2.98, $3, and we go straight up to 360. We pull back for a second and then we go up to 380 and up to 390. 1, 2, 3 candles of pullback. First candle to make a new high gives you enough of an opportunity at least to get a small winner here if you weren't able to get in for the break of pre-market highs. This one you only would have been able to hit if you were watching it pre-market, but you could have because it was on the scanners. So you could have had your order ready at 3, and then when you suddenly started to see volume coming in right here at 285, 290, you could have punched it at $3 and been in it right at 3. Once I know, Arthur, the setup, at that point, I'm not really watching the chart, I'm watching the level 2, because the level 2 will show me the current price, and it'll show me whether we have a lot of buyers or a lot of sellers. This one right here, BSI, pre-market high was 350. We popped up here, we broke through 350. Now, this one gave you 2 potential trades. The first one, of course, would be an entry at 350, which was pre-market highs and a $0.50. And then from there, we squeezed all the way up to 410. We pulled back, 1 candle of rest, 2 candles of rest. Second trade would be over 4 for the first candle to make the new high. And there, from that point, we went from 4 to 420, 440, 465. 465 high, and then a pullback. The second opportunity on this one would have been a 1-minute opening range breakout. We'll cover that strategy more in a second, but this 1-minute candle, you enter at the high and you set your stop at the low. So you let the first 1-minute candle close if the stock is strong, and as soon as the next candle breaks the high, you enter based on the high of that first 1-minute candle. If it breaks the low, you don't trade it. It's not a trade. But if it breaks the high, that's the entry. This is a trade where 90% of the students who traded it were profitable. The entry, number 1, was either at 320 or getting in at 350 for the $0.50 break. Here's another break of pre-market highs. This stock squeezed up and had a pre-market high of 217. This is a nice and a clean one. It's easy to see. Couple candles of pullback, first candle to make a new high. Now you could have gotten in this for the 1-minute bull flag, because this is a bull flag. You've got the move up, you've got 2 candles of pullback, first candle to make a new high is an entry. So you could have gotten in this at $2 based on this pre-market flag, and that would have been totally acceptable. Waiting until 217 is okay as well. You're waiting for confirmation of the break of pre-market highs, and you're getting in a little higher. This is a better spot when you have a well-defined bull flag, which in this case you do. So the entry, $2 or maybe 217, you get a move up to 260. Look what happens on the first pullback. First pullback gets bought up. First candle to make a new high is an entry. So in a moment when we talk about buying pullbacks, for those of you who don't want to trade in the first 2 minutes, you can wait for the pullback. The only problem is that sometimes the stock will go from $2 to $8 without giving you that pullback. So in any case, this went now from, on the first pullback, from 240 all the way up to 350. Really solid, easy trade. This is another one, ATV, pre-market high was 745, just underneath the $0.50. We opened a little bit lower and then we squeezed up. Again, two ways you could trade this. The first way would be a 1 minute opening range breakout, and that probably would have been the best way because it also formed the bull flag pre-market. 1, 2, 3 candles of pullback. Then you have the green candle. First candle to make the new high, that's the entry. You squeeze up. You can double your position over pre-market highs or take your first position if that's where you're looking to get in. You get the squeeze up to 782 and then 1 candle of pullback, 2 candles of pullback. And what happens here? First candle makes a new high, so the first pullback works. And we get that squeeze from 780 all the way up to 880. That's a really nice move. Remember, this stock met all of our criteria for being the right type of stock to trade. That's why we were watching it in the first place. It was gapping up. That's how we found the stock. The pre-market high was our entry. Now, sometimes the pre-market high is fairly extended. It's way up here, and we want to take an entry based on a pre-market pivot. So strategy number 2 for entering a gap and go stock is to buy the pre-market pivot. So we get this move up, we get the pullback, the first candle pre-market, a little bit more sell-off. The high of this pivot is usually going to be my entry point. So if this was 4 and this was 350, my entry would be over 350. First target is a break of high of day. Okay, so that's kind of like the A, B, C, D pattern, except pre-market. It's a little different, but it's similar. So when you're buying the pre-market pivot, this is a strategy that we trade from 9:30 to 9:45. The float is the same, under 50 million, but lower is better. Stop loss, low of the last 5-minute candle or arbitrary stops, 5, 10, 20 cents, etc. Profit targets, 10, 20, 40 cents. The range today on these should already be up at least 10%. The stock should have a catalyst or be a former runner. Technical breakouts are okay, but again, it should meet all of our criteria as per Chapter 3 for being a stock in play. Price range preferred is between $150 and $10, but it's applicable for all prices. Higher prices should be the 5-minute pattern only. How do you find the stocks? On the gap scanners, that will show us the stocks gapping up, and then we'll find the pivot based on the pre-market chart. Just like the break of pre-market highs, I prepare my order in the order entry window where I can type in my share size, the price, choose my route, and then I'm ready to press the buy button. Alternatively, I can press Control 1 to just simply buy with my hotkey. And Karine, to answer your question, range means, yes, it's gapping up at least 10%. That's preferred, that we have a 10% gap. So this is an example of a pre-market pivot. The pre-market high is 750, but we pulled back. We popped up to here, which is 740, which becomes the pivot, but then we drop down again, we pop up, and then we drop down. So the high of the last pop is the pivot. That's that little circle right there. And as soon as the bell rings, we pop up, we break through the pivot, and we go up higher. This would be an entry right here at 730, and you got to move up to 780. That's a good opportunity. Even though the 5-minute chart didn't hold those levels, that's still an opportunity for 30, 40 cents of profit, maybe more. 2,000 shares, that's $500 easily. That's your daily goal in one trade, buying the pre-market pivot. Tom, your question, when you refer to high-cost stocks to use only the 5-minute chart, I'm referring generally to above 20. 10 is still kind of in the so-so range, but definitely above 20. This is a great example of a pre-market pivot. You have a pre-market high, which is the top of this candle, but then the consolidation is right down here at 260. So that's kind of the spot that we know, we call it a pivot, because if we break over that level, it's critical. So if we break over 260, that's really an important spot. And guess what happened? We broke 260 and we went to $3 and then to 320. We pulled back, and what happened on the first pullback? The first pullback got bought up. So again, if for whatever reason you miss your entry here, or you simply decided to just not take it, you can buy the first pullback. First pullback gets bought up. So this is a trade where I would take this trade, and then I would also take this trade. So here from 260, 270 up to 350, and then 450, 474 was the high. Okay, so I don't have a video on that one, but I think that that is fairly self-explanatory. So I'll just go back to this example. The pivot level here is usually just below the highs. Any questions on that one? This is a little bit of a cup formation right here. Yeah, the cup. Now, that's not really a problem, except that you wouldn't want to be a buyer up at the top of the cup. You want to be always in from the low of the pullback and then sell through that squeeze. All right, so setup number one is buying a break of pre-market highs, which you could have done in this one, but you would have been buying it a little too high. So buying the pivot gives you an entry just a little bit lower. And yes, the 9 moving average here is in gray or white. So entry setup number 3 for the gap and go strategy is the 1 minute opening range breakout on the 1 minute chart. Okay, so if this is our 1 minute candle right here, the top of the candle is the entry and the bottom of the candle would be your stop. Now, sometimes if that's more than 20 cents, you simply use the arbitrary stop to sell in the middle. But I use this, the 1 minute opening range breakout, sometimes on stocks where I just missed my proper entry, which was maybe the break of this pivot right here, or the break of pre-market highs. Or other times I do it when the stock is really extended and I just want to kind of give it a second to open and see what it does, and then I buy the next candle as it makes a new high. So the 1 minute opening range breakout, some people call it an ORB setup, is a gap and go strategy chart pattern. It's only for the 1 minute time frame. This is one that I only trade from 9:30 to 9:35, so only in the first 5 minutes. Low float stock under 50 million shares is preferred, but works on all price ranges and all floats as long as there's high relative volume. Stop loss is the low of the opening 1 minute candle or an arbitrary 5, 10, 20 cent stop with profit targets at 10, 20, or 40 cents. The range today, the stock should already be gapping up 10%. You know, we say 5% is the minimum, which is true, but the more the gap, really the better because it shows additional strength. Same requirements as the other gap stocks, same price range. We find these stocks either on the gap scanners or on the high day scanners as they start squeezing. So what sometimes happens is that there'll be a stock that was gapping up that I just wasn't watching that closely. And then suddenly when the bell rings, I'm seeing it on my high day scanner. And I'm like, oh, I want to get into this. I'll wait for that 1 minute rest candle. So it's the 1 minute opening range breakout. Now, this is our order entry window, which is the same as the others. I type in my entry, my share size, my price, and then I can press buy or simply use my hotkey Control-1. This is a good example, OHGI, of a 1 minute opening range breakout. So this candle in the first, we basically broke pre-market highs of 235 and we popped up to 269. And I was like, okay, well, this just popped up really quickly. I'll wait for the first candle to make the new high and I'll enter at 269. The 1 minute opening range breakout. Stop is the low of that candle or 20 cents. 20 cents would have been closer, so the stop would be 250. And this went from 269 up to 350 and just under $4. What happens on the first pullback? It gets bought up. So again, if you don't feel comfortable trading a setup like this, you can always wait for the 1 minute pullback. The 1 minute pullback generally will be the safest, whether it's the 1 minute or the 5 minute. The first pullback is generally the safest, but these are 5 strategies that you can use to get an extra edge, to get into these stocks before anyone else. So you're in first, you already have profit, and by the time you're getting this 1 minute pullback, you've already booked $500 or $1,000 profit. And for the times where it just goes straight up and doesn't pull back, you're green. So this is the close-up of OHGI, that first 1 minute candle. The high of that candle is your entry. The low is your stop, or 20 cents. All right, so this is that, one of the setups that we've seen on kind of a regular basis is where we've seen the first 1 minute candle be really, really big. If the first 1 minute candle is really big, then I have to wait for a pullback. But it's when the 1 minute candle is kind of small, just sort of opens and it's kind of a smaller candle, that's when I'm going to be more inclined to use it as a trigger candle. If it's a really tall candle, then I do have to wait for a pullback. So this one on OHGI is kind of a perfect example because it's a little doji. It's kind of just like a little bit of a resting candle, and then we get the move higher. Now, the fourth setup is the first pullback, which you can trade on the 1 minute and the 5 minute. This is probably the lowest risk gap and go strategy. It's the lowest risk setup for the gap and go strategy. I would say the first pullback is the lowest risk, and then the second one would be the break of pre-market highs. The 1 minute opening range breakout is a little bit more difficult because it takes some discretion. You kind of have to make that decision. Is this too big of a candle? Is it too small? Is it too extended? Is it not? The break of the pre-market pivot can be a little bit more arbitrary. I think this is the pivot, but someone else might think it's this. The break of pre-market highs are pre-market highs. Everyone's looking at the same price. And the first pullback, everyone's looking at the first pullback. So these are two really obvious setups, and maybe in the next class, I'll change the order so we do them in order of which one is easiest. So first pullback setup, gap and go strategy chart pattern can be applied to the 1 minute or 5 minute time frame, valid from 9:30 until 10 a.m. If it's past 10 a.m., it's no longer a gap and go pullback. It's just a standard momentum pullback. Just typical old momentum. Doesn't need to have been a gapper. The best stocks, low float, under 50 million, below 10 is preferred. Stop loss can be the low of the last 5 minute candle or the last 1 minute, or arbitrary stops, 5, 10, 20 cents. The range is the same, should be already up 10%. Requirements, the same. Price range is the same. How do we find the stocks? We find them on the gap scanners, and we find them on the high day scanners, because that'll show us the stocks that are spiking up. Then we simply wait for the first pullback. Order entry window, while that pullback is forming, I can start typing in my share size and the price that I want to get in at. Where is the price to get in on a pullback? It's almost always the first candle to make a new high. So I can look at the high of the last candle and say, okay, well, the high of that last candle is 330. So I know when 330 breaks, that's where I'll want to get in. So I can prepare my order for 330. And then if that candle closes and the next one closes lower, I can say, okay, well, the high of that candle is 325. So I just keep moving my order down a little bit until finally we get that first candle that makes the new high. Alternatively, I can just use hotkeys, but the risk with hotkeys is that I can get a little bit more slippage. All right, this is KTOV, first pullback. So look right here, this spiked up, and then we had these resting candles right here around 415. So this is a live example of trading the first pullback. So let's see, we're at 934. We've got the high here. Actually, now we're all the way up to 437. Okay, I got in this one a little bit higher. You know what? Probably the right entry on this one would have been right here, but I missed it. So we popped up and I got in on this second candle. It pulled back for a moment right underneath 450. So I got in at the $0.50 of 450. We hit that resistance, we dipped down, and as we came back over it, that was my entry at 450. So $0.50 entry on this one. And let's see what this does. So we're 452 by 453. I've got 2,800 shares, it looks like, plus or minus. We've got a high of 458. This is kind of one of those times where I would be like, okay, I'm in this a little high and we're going sideways. That's not really what I wanted to see. This needs to break the high over 58 pretty quickly. Otherwise, I'm not going to be feeling super confident. But there we go. We broke over 58. Now we've got 471 by 483. And now we're starting to think, okay, $5 is becoming a realistic target. As we broke over 475, $5 became the next logical spot. So I'm up 800 bucks, right around there, $800, and um, $500 now, actually $600. So just kind of watching. We know we have a high now of 83. So 83 is the price level that I'm watching. I'm going to watch the level 2 based on the chart to see how the price acts around high of day. More buying is coming in at 83. That tells me this is definitely strong. 88 on the ask. I actually decided to be aggressive and add at 83, thinking that the target was a move to $5. So I added, now I've got 4,800 shares with an average in the 60s, looking for the break over 5, a little resistance at the whole dollar, which is typical. We want to see that we break it. I don't want to see, that's what I get a little nervous about when we hit the whole dollar and we pull back off it. I want to see us break through it and pop up to 505 and 510, and that's where I would start to sell it for the break through that level. So we've got 92 on the ask right now, 90 on the bid. So remember the best entry would have been right down here around 420. I got in at the $0.50 and there. That was, for sure a disappointing trade because in that candle we came all the way back down. So I went from being up 1,200 bucks to only having $530 sold at 75 as we came back down. And that was the right thing to do. So let's see. Looks like I got back in for a break over 5, but it wasn't really a clean break. So, all right, next one. So the first pullback, 1 minute and 5 minute. As we've talked about, the first and second pullbacks are almost always bought up. All right, and this is kind of where we transition from gap and go trading to momentum trading. Once we see that the stock is strong, regardless of whether it was a gapper, traders are going to be looking for an opportunity. So this is that example of OHGI, the first 1 minute pullback right here, getting bought up and giving us a great opportunity for a move higher. Here's that BOSC one, first 1 minute pullback, or 5 minute pullback actually, gets bought up and we move higher. So this is the first pullback on the 5 minute time frame. And that's what we will see on the strongest gap and go stocks. We will see them first break pre-market highs and give us that squeeze. And then the first pullback will get bought up and we'll get trade number 2. So you can trade first the break of pre-market highs, and then you can trade the first pullback. You can potentially trade 2 of the gap and go strategies on one stock. Number 5 is the red to green move. And this one is a little bit tricky. This is when a stock ends up selling off as soon as the bell rings and you buy the first candle to make a new high. So we have 1, 2 candles of pullback, 3 candles. First candle to make a new high is where we often get that squeeze back up. So we're red on the day and then we squeeze and we go through the open price, and that's when we're green on the day. Now, the red to green move, I only trade from 9:30 to 9:45, and I'm going to keep really, really tight stops on it because the stock has already shown a little bit of weakness, which is obviously not ideal. I mean, we want to be getting in stocks that are simply strong, not, that are dipping down as soon as the bell rings. So I have to be more cautious on these, but what I'm looking for is that sign of the momentum shifting, where we have lots of selling, and then we have that moment where we shift to the power of the buyers and we squeeze up. Let's see, let me go to the next one. Order entry window is the same, share size, entering the price, ready to press the buy button for the first candle to make a new high. So this is an example of a stock where you had a couple of opportunities. You could have traded this on the break of pre-market highs, which would have been an entry at 340. It popped up to 360. You could have taken 15 cents profit and then stopped out break even on the rest. So you could have traded this one for the break or pre-market highs. And then it sells off and you say, okay, it's weak. Let me watch it for a red to green move. See if it dips down, first candle to make a new high. Now I get in for the red to green move. We squeeze up from 320 up to 360. And now what's this? The first pullback. We're trading 3 gap and go strategies on this one stock. These are 3 specific entries. Now, you can be, as I've said before, you want to be a master of at least one strategy. And the first one to trade is for sure the pullback, the 1 minute and 5 minute pullback. These are super, super solid and we see them all the time. If you can learn the red to green move, it gives you another opportunity to capture profit. So this right here, 320 entry, selling through the high. Or of course, the break of pre-market highs, which we can see can be a little bit tricky because some of them are false breaks, but that's true with pullbacks as well. We sometimes get false breaks where, like this one, we go up and then we come back down. Now, a perfect red to green move will sell off 10%. Because when they sell off 10%, it turns on short sale restriction, which means it's going to be harder for short bias traders to take short positions. And that's good. I mean, that is good for long bias traders. So dipping down 10%, short sale restriction turns on, and then squeezing out of the gates. Let me just look at your question here. What would cause a red to green move? Well, sometimes if the gap was really a big gap, you have a little bit of profit taking. So as soon as the bell rings, some people take profit who are maybe holding it for a few weeks. Sometimes it's short sellers who think the move is overdone and it's going to drop back down. Those are 2 possible reasons for a little bit of a red to green move. Roxanne, if I'm watching the 5-minute candle for the new high, but the 1-minute candles are giving you a new high, which would you wait for, the 5-minute or the 1-minute? Well, this setup right here would have been a 1-minute setup. You have 3 1-minute candles that drop down, and then the first one makes the new high. So at that point where I would have been entering this on the 1-minute, the 5-minute candle would have still been red. But that's okay because it looked like a good setup. It's clean. You've got 1 candle, 2 candles, 3 candles, so it's worth a try here. Now, if it didn't work, it popped up and then continued to sell off, then at that point, we might say, okay, well, let's wait for the 5-minute candle. Maybe we'll get 3 5-minute candles in a row, and then the first candle to make a new high, would be the opportunity. And you never know. Sometimes they just continue to be weak, but those are the levels that we would be watching. All right, so let's see. Here's another red to green move. This stock was fairly extended pre-market. We squeezed up 330, 350, 430, 450, 490, and then the bell rang and it just sold off. First candle to make a new high right here, we popped up, but then we pulled back. So it was kind of like a false break on the red to green, and then the second one worked. So this would have been a tricky setup because even though we never went back down to low of day, which is usually your stop would be low of day, unless that's more than 20 cents. If it's more than 20 cents, you stop out here, and on this one you might have gotten stopped out and then it ends up running to 5 and you'd feel a little annoyed. That's possible. This wasn't the cleanest setup, but that is a red to green move. We have the CLRB one as well. Let's see. So I think I guess I don't have a video of that one either, which is strange. But in any case, of course, I'll continue to add videos as I get good examples of them. The red to green move is definitely not my favorite though. The reason is because you have that initial weakness, and I just don't like to see that weakness. I would much rather see a stock that's simply strong right out of the gates. I mean, that would be what I would prefer. Okay, so let's see. Let me jump back in here. So the gap and go process, and this is your process each morning. Number 1, the beginning of the process is finding a stock on your gap scanners, right? Open up the gap scanner and start building your watch list. And this is what I said you guys should start doing in class 2, in class 3. Start building your watch list each day. Check the news and break down the daily levels for support and resistance. and then choose a potential entry. So let's pull up an example from a trade today. Let's see. So today we were watching DFFN. So DFFN this morning, we had a pre-market high of 470. All right, so pre-market high was 470 right up here, and then we had a pre-market pivot of 460. But then we could tell that the market was going to open just below 450, the half dollar. So on this one, I said, well, I could get in at 450. If I get in early, my stop is tighter. If I wait for confirmation, I'm getting in higher, my stop is further away. So that's why it's often better to get in a little early if the stock meets our criteria for being in play. And this one did. It had a low float. It had a good catalyst. It had the headline. The daily chart had room up to 561, which was our 200 moving average. So we had some room up here, up to 550 or so. And I figured, okay, this is one that's a former runner. It's got potential. We had this day where it made this big move all the way up to $16. So definitely one to watch. I decided to jump in, let's see, for the break over 450, and we pop up to 73. But we knew that the pre-market high was 70. So when we hit only 73 and then we started to see some resistance, I got nervous, and that's when I sold. Okay, but my process, find the stock, look for the potential entry. The potential entry was going to be over 60, which was the high of this pivot right here. And then we ended up opening just below 450. We opened a little bit lower, so I got in for the half dollar break. We popped up to 70, and then I sold as we came back down to 60. But either 60 or 50 would have been good entries. 60 is the pre-market pivot. 50 was the break over the half dollar in anticipation that once we broke that level, we would hit the pivot. Once we break the pivot, we'd hit high a day. Once we hit high a day, we've got potential to squeeze further. Unfortunately, we just didn't. Right? But that's the process. Okay, so the process is you find a stock. GBR today, we find a stock on the scans. It's gapping up. It has a catalyst. It has a good daily chart. Okay, so what's our entry on this? We've got the pivot at 62, and then we have got the pivot right here, which is at the half dollar of 250. Okay, so this right here is a solid entry. Entry at 250, stop maybe 5 cents at 245. First target 62, second target is high of day. So pre-market, we already have a sense of a potential entry on this stock. Once the bell rings, I'm ready to take the trade, and I'm ready to press the buy button. Now, as soon as I press the buy button, I'm watching the level 2. I look at the chart to understand the price that I want to get in at, because the price for my entry is based on a chart pattern. But once I'm in the trade, I only need to watch the level 2, at least for the first 30 seconds, because I need to see, are buyers coming in? Are we seeing that we're breaking over this price? Am I instantly up 10 cents? Or am I instantly down 10 cents? So I'm watching the level 2 and I'm watching the time and sales. Once I hit my first profit target, that's when I sell half. Or if I'm sitting there sideways for 3 minutes, that's when I say breakout or bailout. This thing isn't working. I've got to get out. So what are the gap and go exit indicators? These exit indicators are going to be universal for all 5 gap and go strategy patterns. When we enter a gap and go trade based on one of our favorite setups, the favorite one being probably the first pullback, and the second favorite being the break of pre-market highs, then how long do you hold it? With gap and go trades, I usually have a 10-cent stop or a 20-cent stop. That means my profit targets should be between 20 and 30 cents. But we know, based on my statistics, that my profits are 1.5 to 1, profit versus loss. So I make 15 cents on average with a 10-cent stop. Or I make 20 cents on average with a 15-cent stop, or something like that. So my winners are just a little bit bigger than my losers. So with a 10-cent stop, profit target would probably be 15 cents. With a 20-cent stop, profit target would probably be 25, 30 cents. If you are a scalp trader, that means you're getting in quickly. And let's see, that was weird. That means you're getting in quickly, okay? You're looking for that candle as soon as you get in to give you resolution. You're buying the break of the pre-market high, you get in, you look for that immediate break, you look to take the 10 cents and sell half. It goes up another 10, you sell another half. You go up another 10, you sell another half. You keep selling half of your position until you're down to such a small position that you might as well just sell the whole thing. If you're a trend-based trader, the gap and go strategy is of course going to be a faster one, and you're most likely going to focus on pullback entries. But in any case, with a scalp trading mentality, you typically sell based on action you see on the level 2 or the time in sales, which would be seeing a big seller or seeing a lot of red sells go through. If you're a trend-based trader, you'd most likely sell on the first candle to go red. So the first candle to make a new low. So if you've got 3 green candles in a row, you're still holding until the first candle goes red and then you're out. I will begin to sell if, number 1, I see heavy resistance on the level 2 in the form of a big seller, right? That was the example where we saw that 46,000 share seller sitting on the ask. That to me was my cue to get out of the way. In that case, I will bail out by selling on the bid. I'm not going to try to sell on the ask. There's already a huge seller sitting there. I hit the bid, I get out of the way. Number 2, I will sell if I stop seeing buying. If I'm seeing a lot of selling on the level 2 and on the time in sales, I'll bail by simply selling on the bid. I'm not going to be able to sell on the ask when we're only seeing sellers. There's no buyers there to buy my shares. So if I see lots of red going through and I'm only up a little bit, I would rather just get out break even than take a loss. If I'm up 20 or 30 cents, I might sell half as I see that selling and keep my stop at break even on the rest. Now remember, in class 10, I'm going to show you how to read the time in sales and the level 2. So you will learn more about that in the coming classes, and I understand if it's a little confusing right now. All right. Number 3, if my profit target has been touched, I'll sell half on the ask. Because the stock is moving up, I'll sell on the ask to get the best price. I'll adjust my stop on the rest of my position to my average cost. If my second or third profit targets hit, I'll continue to sell small pieces on the ask, selling half until I'm down to a really small position and I might as well just sell the rest. Number 5, if my entry is on the 5-minute chart, I will typically sell on the first red candle on the 5-minute chart. So and this is basically when I'm holding that final piece. The trade has worked, I'm up 30, 40, 50 cents, I'll hold that final piece until the first red candle. Now, if I'm already up, $1 per share, I could hold through the first red candle and maybe say, well, I'll hold through this 5-minute pullback. But typically, I'll just sell the whole thing and I can get back in as that pullback turns into a bull flag. So let's just back out of that for 1 second. And I'll just show you a couple of quick examples. So on this example here, your exit indicator as a 1-minute trader could have simply been this red candle. You may have said, look, it broke over 4 and then it came back below, I'm going to sell. And you could have gotten back in up here when you had this little bit of consolidation and then the break for the new high. If you're trading based on the 5-minute time frame, you wouldn't have even been getting in here because you wouldn't have seen any pullback at all. You just would have still been waiting on the sidelines. Let's see, let me look for another one from our examples today. Let's see. This is a good one. Your entries here, first red candle, as it breaks the low of the previous candle, that's definitely where I would have sold the rest. I wouldn't hold through this. I would probably have gotten in here and sold half up here once I hit my first profit target, sold another half up here, another half up here, and finally sold my last position as we broke down here. Now, I often set my stops around $0.50 and whole dollars. So I might have said, you know what, if it breaks below 850 after coming up to 887, I'll just sell the rest. And as it dropped here below 850, it's probably a good place to bail out, either there or the first candle to make the new low. Does that make sense to you guys, those exit indicators? We've got the big seller on the level 2. We've got that stream of sellers going through. We have just simply the fact that there's no buyers, there's only sellers. That's an exit indicator. And then we have selling simply because you hit your profit target. That's the best way to sell. The best way to sell is because you hit your profit target. So this candle here was a 1 minute little resting candle, little pullback, and then we moved higher. But this candle that actually made a new low versus the low of the previous would have been an exit indicator. Okay. All right, so let's jump forward here. So back to gap and go exit indicators. So again, to emphasize the couple of things here. And what I'm going to do actually is I'm just going to step out of this for 1 second again. Sorry. All right, we'll step out of this, and I'm just going to go up here and let's see. All right, so this is my slideshow. So I'm gonna change this order, and I'm gonna show you. I'll change this on the PDF. So gap and go setups. Number one would be the first pullback. This is the strongest one. Gap and go in order of quality. Oops. Quality of setup. Number one is the first pullback. That's the easiest one. Number two is the break of pre-market highs. Number three is the break of the pre-market pivot. Number four is our, why is that? Well, whatever. Number four is the 1 minute opening range breakout. I'll fix this later for when I print the PDF. And number five is the red to green move. Okay, so this is the revised order of the gap and go setups that I would say are easiest to hardest. Okay, so there we go. Number one, the first pullback. Number two, the break of pre-market highs. Number three, the break of the pre-market pivot. Number four, a 1 minute opening range breakout. And number five, a red to green move. And then I'll just adjust those accordingly. Does that make sense, guys? So those are the 5 ways that you can trade a stock that's gapping up. So tomorrow, if tomorrow's a trading day, it is for me, probably is for most, well, it is for all of you watching this live, unless you're not trading tomorrow for some reason. If tomorrow is a day that you're going to be trading, what's your process? Your process starts by grabbing the gap scanner. All right, you check the gap scanner, you see which stock is gapping higher. Right? Which one is the highest? Which 3 are the leading gappers? You check those, you check the float, you check for the catalyst, you check the daily chart, then you check the pre-market chart. Does everything line up? Does it meet all 5 or 6 criteria that we broke down in class 3 of stock selection? If it does, then you start to say, okay, I need to find my entry opportunity. Okay, so your entry opportunity will be based on the pre-market chart. So you pull up the pre-market chart, and that's when you either, you look at it and you say, well, this one, I want to trade it, so, I don't want to wait for the first pullback because I think it could be really strong, so I'm going to get in for the break of the pre-market high. Or I'm going to get in for the break of the pre-market pivot. And then you go into Fantasy Stock Traders, and you start typing in your potential entry spot. This is where I want to get in because of this. So in this case here, you would have been getting in right around the high of this pivot, right? In the case of some of these other ones, you'd be getting in around pre-market highs, etc. So the exact entry, will depend entirely on the stocks on that particular day. Some of them have really clean pre-market charts where you can say, look, that's a perfect pre-market high. That's my entry. Others are going to be a little bit sloppy, and you need to just wait for the first pullback. Now, today on CYCC, for instance, this is one that I was like, I can't trade it out of the gates. It's sold off too much, so I would wait for the first pullback. This one ended up doing this really dramatic red to green move, but it certainly wasn't something that would have been easy to trade. The red to green move wasn't until like 40 minutes into the day, so it wasn't our obvious red to green setup. All right, so let me go back here. So I broke down my 5 entry setups for gap and go trades. And now I'm going to, let's see, my 5 entry setups. I gave you the gap and go process. We've got the gap and go exit indicators, and a final reminder, breakout or bailout mentality is super important when it comes to gap and go stocks. These stocks are already up 10 or 15%. It's not impossible that they'll gap up and sell off. But generally speaking, if they have a good catalyst, if they're one of the top 3 gappers of the day, they're the new, they're the shiny object. They're the new jungle gym on the playground that every trader is going to gravitate towards. Those are the stocks traders are going to be watching. So there's a really good chance they'll make a move higher. But if they don't work out, within 5 minutes of entering the trade, just get out. Get out, break even. You don't want to just sit sideways on these because, as you can see on CYCC today, when you sit on these just sideways, out of nowhere, someone holding the short is down 2 points. You get up to go walk the dog, you come back, it's at 1085. You buy this long, you get up to go walk the dog, it's back down at 850. You short it to go, and then you go walk the dog, it's back up at $10. I mean, this is why you get in, you capture your profit, you get out of the way. You have to be like that with trading. You have to be super, super meticulous. You dial in your entries down to the penny. The gap, maybe you're walking your cat. I don't know. Right, of course, Al. You've got your gap and go entries. You've got your 5 setups, your 5 entry opportunities, pre-market highs, the pivot, the first pullback, the red to green move, the opening range breakout, entries knowing that half dollars and whole dollars are very well respected areas of support and resistance. So you're watching these key levels. You're looking at the daily chart. You're waiting for that opportunity, and then you strike. You grab it, you get it, you pull $6,400 out of the market, and you're done for the day. That's what I did yesterday. I got in, I got aggressive, I got out. Today, I got in, I got 1,200 bucks, and I got out. That'll be my same approach tomorrow. That's the same approach that I've had every single day this year and every day last year. That's how I made $222,000. I get in, capture my profit, I get out. So right when the bell rings, as soon as the bell rings each morning, I've already got my trades ready to go, and I often take my first trades within the first minute. Those trades I'm taking based on pre-market charts, based on the gap scanner. That's how I found them. That's how I established potential entry spots and profit targets and stop losses. Now, once we get into 5, 10, 15 minutes of the market opening, now I can start to switch gears. Some of the gappers may have fallen off my watch list because they failed right away. They just sold off. Other days I may not have had a lot of stocks on the watch list period. And so that's when I'm going to start watching my high day momentum scanner. So what we're going to do here in just 1 second is we're going to shift gears, and I'm going to show you about the second part of the momentum strategy, which is non-gapping stocks, or it's simply trading stocks past 9:45 or 10 a.m. that are experiencing momentum. We will find those not on our gap scanner, but on our momentum scanner. All right, and I'm going to give you a couple of case studies here of gap and go stocks. So here's a day where we pulled up the gap scanner, and OHGI was our 3rd leading gapper. We had BioC on here, but I just wasn't as crazy about it, although I did end up trading it. I was watching both BioC and OHGI. Floats 13 and 14 million shares. Then we had Rally, which I didn't like because it was $19. So these were our top 3 gappers, and I liked 2 of them. I was watching these 2 for a trade. OHGI, I go on Market Watch, there was news. One Horizon Group, the company announced that its app is now supported in China's mobile pay platforms, including Alibaba. That's big. Alibaba is a big company. That's like a US company being featured with Walmart. It's a big deal. So 216, watching long over 220. All right, we've got the pre-market high here, which was 236. As soon as the bell rang, it squeezed up. Remember, this is the one that gave me the 1 minute, that 1 minute opening range breakout. From 236 up 100% to 582. The entry was the 1-minute opening range breakout on that particular trade. And on that day, 91% of our students who traded that stock made money on it. Here's another one, CDTI. We already kind of looked at this one. It's our second leading gapper. Our first gapper is a 53 million share float, so I'm not super interested. CDTI is 13 million shares, so I like it more. Gapping up, 300,000 shares of volume, not bad. I go to MarketWatch. I check the headline. The headline is good. There's some news on it. It's gapping up 14%. I kind of break it down for our students. The daily chart also looked good on it. OHGI also had a good daily chart. Both of them checked out with daily chart. Here we go. The bell rings. Pre-market high is 250. Now, what's interesting on this is we also had a 1-minute opening range breakout. We opened flat with this little candle here. We had a second little candle of rest, and I got in. I knew 250 was our pre-market high, but I said, why wait for 250 when I can get in right here? I got in right there at 240, and boom, we popped up to a high of 290. What happens on the first 1-minute pullback? It gets bought up. You can add right here at 290 for the break over 3 up to 320, little chop up to 330, little chop up to 338. Really, really nice, easy trade. 88% of the traders who took a trade on CDTI on that day were profitable. Now here's BLFS. Pre-market gapper down here, only 12,000 shares of pre-market volume, 5.97 million share float. This one had a catalyst as well. It's biotech stock, so kind of biotechy language. But the pre-market flag, a little on the messy side. I wasn't super crazy about it. We had the high of 240, but we were kind of selling off. The candles that were really standing out to me were these 3 red candles. So I was like, you know what? I don't really like it, and I chose a couple of other stocks to watch instead. I was watching PBMD, even though the float was a little higher, and SYN I was watching, and URRE. So I was watching different ones because I thought their pre-market charts were better. Well, what ended up happening is as soon as the bell rang, it started spiking up. Okay, it started to pop up, and so right at 9:31, it's hitting my high-a-day momentum scanner. And so it captured my attention immediately as it popped up here to 263 and 264. So look at this candle. This right here, it popped up to 250, it pulled back, and then suddenly it squeezes up to 250, to $3, $3.50, $4, $4.44. Nearly 100% in 3 minutes. That is an opportunity. Now, the tricky thing on this one is that because it wasn't really close on my radar, the entry would have been tricky, right? I mean, it just wasn't an easy one to get into because, yes, 250 would have been fine, 1-minute opening range breakout if you saw it there. I didn't see it there. You know, by the time it's spiking up here, you could have gotten in for the whole dollar break at 3, but you know, we know that that's risky when you're just kind of buying it as it's squeezing. You know, you could have, I mean, gotten in at 350, but that's even riskier. So I don't remember where I traded this one or if I even traded it at all, but it goes to show that sometimes a stock will start spiking up, and that's where you watch the high day scanner for the first 1-minute pullback. Now the first 1-minute pullback is right here for the entry over 4, and it ended up being a false break, which is not surprising because it just squeezed 100%. You know, when a stock makes that kind of move, it can often be too extended. All right, so a couple more live examples of gap and go trades. This one was a trade on LEU. I got in this for just over pre-market highs. Entry was 355, and you got that pop pretty quickly up to 375. Back of my mind target is $4. So I've got an average here of 355. I got in with a little bit of slippage, which is obviously not ideal. I'd rather get in right at 350, but with that offset, a little bit of slippage. To answer your question, the circuit breaker halts are lower on stocks under $3 and that open under $3, and they're lower in the first 15 minutes. The bands are doubled. So 10% for a regular stock is 20% in the first 5 minutes or first 15 minutes. Stocks that are regularly 20% are 40% in the first 15 minutes. So on this stock right here on LEU, getting in at the $0.50 break for the break of the pre-market highs, even though I filled a little on the high side, I was still able to capture a pretty quick profit of $660 and still holding 1,300 shares with a stop at break even. My stop is now break even, which means if these 1,300 shares go back down to 56, I'm out. If they go up to $4, I'll make another $400 on it, or $500. So let's see. Next one is ZFGN, $500 in 2 minutes on a gap and go setup. Pre-market high is 8. Pre-market pivot is 780. So ZFGN, I've got my order ready at 780 for the break of that pre-market pivot. Pre-market high is $8. In this case, I waited for $8 because for whatever reason, I decided to wait for the whole dollar, which is fine. I got in at 8. I waited for confirmation, so I got in a little on the higher side, which meant I needed to take profit sooner. I sold half when I had 10 cents. 4,000 shares, took half at 10 cents. I'm up $447. Stop is break even on the rest, and I've got an order at 8:01 to sell the rest. That's 2 minutes, $500, buying, on this case, the break of pre-market highs. Now, if I saw this one today, I probably would have tried to get in at 79 because you can see right before the bell, 79 is the high of that pivot. So I would have been like, I want to get in at 79. Well, I don't know why I would wait till $8. For whatever reason, I wanted to wait for confirmation. Daily chart, fantastic, really strong. Yeah, I don't know why I waited as long as I did. I think I was just being a little more conservative, waiting for confirmation. The problem with waiting for confirmation is that you always pay a higher price. That means your profits are smaller. And you kind of learn that if you get in a little early anticipating the moves, your risk is higher in the sense that you don't have confirmation, but it's lower in the sense that when you're in early, your stop is closer and you've got a better price. And then when it works, the win makes up for it. So I've found that anticipating the breakouts is okay on stocks that meet all of my criteria. You know, it's a gapper, it's in play for these reasons, etc. All right, here's one, $1,600 in 15 minutes on gap and go stocks. All right, so let's see. We've got a minute to the bell, and I'll tell you right, even in the last, 2 minutes, I always kind of have to take a breath because I can feel my blood pressure rising. I'm getting ready for, it's like game time. I know the game's about to start, and I've got to be, really in the zone. So as I'm watching that kind of countdown, I'm getting myself amped up. I'm ready to jump in. On this one, I've got couple stocks I'm watching, GBSN, I've got GNCA, I don't remember which one I trade. So let's see, here's the bell, 5 seconds left, 4, 3, 2, 1, there's the bell. Got my order ready on GBSN at 750. I put the order at 750 and I'm watching 721 right now. I'm watching to see volume coming in. Right now, nothing's happening. And there we just dropped for a second. I'm watching for volume. I want to see buyers. Right now we have a cross level 2, which is a little unusual, but sometimes that happens where you have 720 on the bid and 711 on the ask. This is a stale order that will disappear. If you sold right now, you would fill at 701, not at 720. It's a stale order that will go away in a second. So we're 7 by 704 with a stale order at 720, which it would not execute your trade at that level. It's just sitting there. So right now, notice on this chart that we have a pre-market high of 750. That's why I had my order prepared at 751. But we opened a little bit lower, and what do we have? This is a red to green move. The entry price is going to be over 720. As soon as we pop up there, we're going to go to 785. So 720 is the red to green spot, the first candle to make a new high. All right, so that's the spot we're watching. This candle has 3 seconds left, 2 seconds. First candle's closed with a high of 720. We're watching for volume to come in. We're still watching it because it's a gapper. Look at how much the stock is, has been in play the last 2 days. This is actually a follow-through day on the previous day, but it was still a slight gap. 703, 702, just sitting and waiting. We saw some orders go through at 703. It's going to just kind of come out of nowhere. And that's the thing. There are so many traders watching this that a couple, traders with really big accounts that suddenly see this opportunity and jump in right there. Look at that. 715 on the ask. All of a sudden, we've got 715 on the ask. 18, some buyers going through. 21. And now I'm watching this and I'm thinking, okay, this looks like it's time. There we go. I jumped in. I actually got faked out. I got faked out there because I thought that, let's see, let me just back this up for 1 second. When I pressed the order, I thought that seller at 21 was going to go away and it was going to go at 27. And suddenly I got filled as it dropped, which was like, whoa, that was a surprise. But okay, I'm in now at 716 and I'm just going to give it a second. I'm suddenly down 16 cents and I'm about to bail out below 7. Below 7, I'm going to have to bail out. And there we go. Whew, that was a close one, right? Not the first time that's happened. 740 on the ask. Okay, good. We got to break over the $0.50. 750. I'm up 770, up $900, 760. I sold. I'm getting ready to sell. Let's see. I've got my order out. I'm putting orders on the ask at 59. There we go. Sold at 50, 57, and 54. Booking some profit. Getting myself into the driver's seat. So now I'm down to 625 shares. I'm out of the danger zone, into the green. And what are we having right here? We're having the first 1 minute pullback. This right here is the first 1 minute pullback after the breakout. What happens to the first 1 minute pullback? It gets bought up and we'll see traders come in over 760 for the move up to 785. So red to green move and first 1 minute pullback. I've got my order ready at 762 right now to add. I'm ready to add back for the break of 760, and now I'm thinking $8 is the target. I'm also looking and noticing that we're breaking yesterday's high. When we break yesterday's high, we have continuation. We have the opportunity to move higher. All right, so ended up selling on the bid at 51 because I was like, you know what? I'm just going to bail out. It's not quite ready. Let's see. And then, oops, let's see. All of a sudden it drops down and it's going to surge back up. I've still got my order ready at 60 and I'm back in. Long at 60. There we've got 70 on the ask. I sell half at 74. 84 is on the ask. I've got an order at 85 to sell half. Okay, half is 625 shares of my 1250 order. Now, it does the math automatically. I don't have to do the math. I press the key to sell half. It calculates half. All right, now I'm up over $1,000 on this stock. This was during my Short Trader channel. Or no, I guess, when was this? Oh, this was just sometime last year. Or this might have even been 2015. This was a while ago. I'm not sure what the date is here. 2016. Anyways, so scaling out, now we've got 63 on the bid by 69. My average is 60, so kind of have to have my hand on the trigger. But just in that moment, I was able, that was a scalp trade. A lot of times these 1 minute setups are scalp trades, but you can see how when you trade the right type of stocks, scalp trades can be very profitable and can have huge windows of potential profit. Okay, so we'll wrap this one up here. So steps that you can take today to trade the gap and go strategy. So all of you right now should be trading in the simulator. practicing every single morning trading in Fantasy Stock Trading Simulator. Now, when you trade in the simulator, you've got your hotkeys. So you can go in here and you can see that you've got Hotkey Manager. You've got your hotkeys, so you can sell. Let me straighten. I'll do by description. Okay, so you've got hotkeys Control Z to close out the full position on the bid. You've got Control X, which is to close out half your position on the bid, and you've got Control C, which is to close out 25% of your position on the bid. You sell those and you're out. Sell, sell, sell. You can bail out of your position. You want to sell on the ask to get the best price. Control plus K is to sell on the ask with a zero offset. Control L is to sell half of your position on the ask. I use L because I'm considering this to be adding liquidity to the market. We'll talk about that in class 10, but just for right now, that's the reason I chose KL and semicolon. Control plus semicolon will sell 25% on the ask. And so with those 6 keys, you can sell on the bid or sell on the ask very quickly. Memorize those keys. They will allow you to capitalize on opportunities as a trader. Now, at the same time, you can type in stuff here. It's slower to do it that way. Now, to get into the trade, when you first get in, you can get in with Shift 1 to buy 1,000 shares. If you want to change this to buying, 2,000 or 3,000 or just 300 or 200, press save, change it, press save. It's all set, not a problem. You can also use your Control P to set your first profit target when you get into the trade, etc. That's all totally fine. You guys need to be practicing trading these gappers every single day. When you get good at them, you can start doing really well. Now, just as an example of that, I'm going to go over here to my TraderView account and get logged in and show you a couple of my stats. All right, so let's see. Reports view. All right, so this is going to be, I'll do a start date of January 1st, 2017. Filter. We'll look at the last 90 days. In the last 90 days, this is what my P&Ls looked like. This is 2017. I'm up right now, it's April 4th, and I'm up, let's see, 123,000 before commissions, 100 and probably 11,000 after commissions. This video will be probably something that traders watch for at least a year. When I make these videos, I try to make them really thorough, do a really good job of them, get them uploaded, and then let you guys enjoy it for 6 months, a year, maybe longer. So I'm sure people will be watching this in the fall, in the winter of 2017, which is totally fine. But the metrics will be the same in terms of, these were my metrics at this time, and this is what you want to look at. So obviously I've had some big drawdowns, et cetera, et cetera. But if I look at my detailed trades, and then we look at time of day, interestingly, I don't make money on Fridays. I've only made $1,200 on Fridays all of this year. I've made $35,000 on Mondays. This is related to the fact that most companies put out really good news, not on Friday before a weekend, but on Monday, Tuesday, and Wednesday, early in the week. We have good headlines early in the week, not a lot of stuff on Fridays. When do I trade the most? It's between 9 a.m. and 10 a.m. Now, let's see if I can show 15-minute. If I look at the 15-minute, I made $56,000 between 9:30 and 9:45, and another $20,000 between 9:45 and 10 a.m. So this is my window where I made 70% of my profits. It's in the first 30 minutes of the day. And then from 10 a.m. through 11:30, profits decrease. So that shows you this is a time of day to be aggressive. If you can get into the market and trade for 30 minutes from 9:30 to 10 a.m., you can be a profitable trader right here if you have a strategy. Let's see, my average hold time, even though I made $35,000 on stocks I held from 20 minutes to 40 minutes, the majority of my profits are trades I'm holding less than 10 minutes. This is 5 to 10 minutes, 35 grand. Under a minute is kind of rare. That's a very quick trade, but I made 11,000 this year. So, 10%. Another 10% came from stocks I held for a minute to 2 minutes. Another 18% or so from 2 minutes to 5 minutes. And then 33%, 5 minutes to 10 minutes. And 33%, 20 minutes and longer. For some reason, 10 minutes to 20 minutes is a kind of low spot. But in any case, this shows you that if you can get in and get out quickly, you can capture profit. These are short trades for the most part. All right. And each day, the price and volume, the stocks I'm trading are these low price stocks, rarely under two, usually between $2 and $10. Obviously, I'm trading big size. 20,000 shares would be the total I traded on that day. If I traded it 3 times with 10,000 shares, it would be 30,000 shares for that stock. So obviously, I do better when I trade with bigger size. That makes sense. Let's see, instrument. You can see the stocks I made the most on and lost the most on. Performance by intraday volume. My performance is better on stocks with higher volume. And my performance is always better, except for this one, on stocks with really high relative volume. High relative volume comes from stocks with a catalyst. If we looked at how many of these stocks were gapping up, I'm sure we would see that the majority are gapping up. Let's see. Performance of instrument opening gap 2% or higher was $57,000. So all of these would be stocks that I traded my momentum strategy on because they just hit my scanners. They didn't happen to be on, they weren't on the gap scanner. So basically half of my trades come from the gap and go strategy. They were gapping up more than 2%. And the other half come from my momentum strategy, which I'm going to show you in just a minute. That's part 2 of this class, chapter 6. All right, guys, so this is TraderView. I import my trades here. You can import your trades, obviously, from the simulator if you want, or you can, let's see, go to warriortrading.com/leaderboards, and you can get basically the same reports for your trading in the simulator right now on the leaderboard. This is giving you almost all of the same metrics. So we can look at, Dennis's metrics, for instance. We click, Dennis can log in, click on his name, and he can see, okay, this is my, average profit per trade. My percentage of success is 15%. That's obviously very, very low. It needs to get higher. I don't even know how I don't know how he's done so well. But anyways, a couple of huge, huge trades. Actually, there's probably been some glitches or something. But anyways, we can see his trade distribution by day of the week, same as mine. You can see the price of stocks he trades. You can see the most profitable time of day by 30-minute intervals. All right. You can get all of this information right here. If you're trading in the fantasy stock trading platform, all of it is right there. Now, I subscribe to TraderView for my own trades. These are all real money trades, and I pay about $100 a month for this. All right. So, anyways, it's useful data. Those are my metrics. Those are my stats. That's super important. I can look at that and I can see, look, I've been trading with 71% accuracy this year. This is important stuff to know. This represents an increase from last year. These are things that you want to be able to watch. Okay, so with that said, let's see, let's jump back in here. So the steps that you can take today to get better at trading the gap and go strategy. Number one, remember, if the 1-minute setup is too fast for you, you can focus on the 5-minute time frames. That's okay, especially as a beginner trader. Remember never to chase the proper entry. So if you miss the proper entry on the 1-minute chart, wait for the 5-minute setup. Every setup has a proper entry. If you miss it, you have to wait for the next setup. When you're in the subway station at Times Square and you see the train leaving the station, do you run and jump on the back of the train and dangle off the back of it when it's going 60 miles an hour through the subway tunnels? No, you wait for the next train. Yeah, okay, it's annoying that I missed that train, but I don't want to die today, so I'll just wait for the next one. Well, you don't want your trading account to die today, so don't chase. Wait for the next opportunity. Wait for the next 5-minute setup. Number 3, don't be a follower. Just because I take a trade doesn't guarantee it's a good trade, because I make mistakes too. But you don't want to just blindly follow me, someone on Twitter, or someone in another chat room, or someone in our own chat room. You want to understand the reason why this is a good trade. And that means if you and I are both taking the same trade because we both see this is a gapper, it's at the top of the gap scanner, pre-market high is 450, the entry is 450, and we both get in at 450, that's okay. We're two traders out of, thousands, hundreds of thousands that are trading the gap in stocks. That's fine. But don't just follow me because I said that it looks good to me. If you do that, when I say I bought at 450, you're going to be buying at 460, and that's not the right entry. If you get in at 460, you're risking an extra 10 cents. With 5,000 shares, you're losing money. You can't do that. And these are fast moving setups, as you can see. You've got to be precise. That means you need to know the entry. So the good news is you can practice in the simulator for as long as you need until you produce metrics that show that you're a profitable trader. And then once you're profitable in the simulator, well, you're ready to transition to real money. You start with small size, and then you start building up your size as you gain more experience. All right, guys, so those are the steps you can take to trade the gap and go strategy. We're going to move on here into part 2, which is trading momentum on stocks that are not gappers. All right, so and that makes up basically the remaining 50% of my profits. So these are the two super important strategies, or well, they're both momentum strategies. They're two variations of how you trade momentum. All right, guys. So let's take like a 2-minute break or just a couple minute break, and then we'll jump in here with chapter 6. Yeah, chapter